Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. From this video onwards, we are going to start revising the profit and gains of business or profession chapter, or as we all call it, the PGBP chapter for CA Intermediate Income Tax syllabus. Okay, but as usual, before beginning the lecture, my request to you is to like this video, and if you haven't subscribed yet, please subscribe to this channel and share it with your friends also, so that more and more students can get benefit of these revision lecture series. Okay, now without further ado, let us begin the revision. So we are going to revise the PGBP chapter. This PGBP chapter is the chapter number unit number 3 of chapter number 4 in your institute study material, and in my notes it is chapter number 9. Firstly, let us start with the definition of business and definition of profession. So definition of business is given in section 2 clause 13, which tells that business includes trade, commerce or manufacture, or any adventure or concern in the nature of trade, commerce or manufacture. Then what is profession? Profession is given in section 2 clause 36, where it is told that profession includes vocation. So normally what we mean by profession, that is definitely profession, but profession also includes vocation. Vocation is any occupation that requires a special knowledge. Now let us see what is meaning of profit or gain as per PGBP chapter. Number 1, profit can be in cash also, or it can be in kind also. Both are considered as PGBP. So if at all I receive a profit in kind, then I should take the cash value of that kind. For example, if a client has given me a laptop worth rupees 1 lakh as my fees, then my profit is going to be how much? 1 lakh rupees. Okay. Next, capital receipts are taxable under PGBP only if it is specifically provided under PGBP chapter. Then voluntary receipts received in the course of business or profession will also be considered as PGBP. For example, a lawyer is getting money from beneficiary and a lawyer is getting money from client, that is definitely PGBP. But if some other person is also getting benefited by the services of lawyer and giving money to the lawyer, that is also PGBP. Then applications of gains is immaterial. For example, if I ask my client to not give me the fees but to give the entire money to charity, then also that entire money will be taxable as PGBP, because giving to charity is application of money, it is spending the money. So whatever money I am receiving will definitely be told as PGBP. Where I spend the money does not matter at all. My income will be treated as PGBP. Then income can be legal income also, illegal income also. So even if I am having a business of kidnapping, that income will be taxable under PGBP. Okay. Next, PGBP is the aggregate of profits of all businesses. So it is not necessary that only one business should be considered as business and other business should be considered as other sources. Okay, that is not the concept. What is the concept? A person can have more than one business also. Okay, in such case, find out the profit of each and every business, then add all the profit together. The entire amount is called PGBP income. Okay, so it is the aggregate of profits of all the businesses. Then profit means net profit and not the gross receipts. However, the net profit you have to find using the rules that are given in PGBP. Okay, by using the computation section. So firstly, let us talk about charging section, section number 28. As usual, every head of income has a charging section and a computation section. Charging section is given under section 28. And what are the points in charging section? Let us see. Number 1, income from business or profession. So first point itself is what? Income from business or profession is called PGBP. See here, come to PGBP. In section 28, that is the charging section of PGBP, there is a small change. If an assessee is engaged in the business of letting out of residential houses, income from such letting out shall not be chargeable under PGBP and would be chargeable under house property. Income from such letting out. Please cut these two words. Okay. Income from such letting out will not be chargeable under PGBP but would be chargeable under house property. What is second one? Any compensation or any other payment due to or received by number 1, person managing the affairs of an Indian company or Indian affairs of a foreign company. I gave you an example of director receiving sitting fees from a company. This will be covered under PGBP. Number 2, agency or termination of agency. So if I am doing agency, that will also consider PGBP, and if my agency is terminated and I am receiving any money, that is also considered as PGBP. Next, if I'm receiving money from the government, for example, for some government contracts, then the money received is also considered as PGBP. And last one, if any business terms are either terminated, means cancelled, or modified, then for termination or modification, if I'm receiving any money, that is also PGBP. Next, if there is any trade, professional or commercial association and such trade, professional or commercial association is giving service to its members and receiving the money, then the money received is called PGBP. Okay, I gave you an example of Codicia when I was taking the classes. Even Sidco, I told you. Next, export incentives. What is export incentives? Any incentive received for the purpose of export. So if either the export incentive is sold and profit is received, or any export incentive is directly received, both are considered as PGBP income. What are the export incentive? Number one, profit on sale of import entitlement, profit on sale of duty entitlement passbook scheme, profit on sale of duty free replenishment certificate, then cash assistance received against exports, and then duty drawbacks. Duty drawbacks. Next, if you receive any benefit or perquisite related to the business, then also it is considered as PGBP. I told you that my company has given me a free trip to Maldives if I sell 1 lakh laptops of the company. Okay. Next, if a partner receives any remuneration from a partnership firm, that is also PGBP. It is not salary, because partner is not the employee of a partnership firm. Partner is a part owner of the partnership firm. Next, sum received for not carrying out any activity. So if I am receiving any money for not carrying out any activity, that is also PGBP. And sum received for not sharing any know-how, patent, copyright, trademark, etc. is also PGBP income. Then if I receive any sum under Keyman insurance policy, that is also PGBP. See, Keyman insurance sum is actually taxable in three different types of head. If the employee is receiving Keyman insurance policy money, then it will be taxable under salary head of income. If the employer company or employer assessee is getting the money, it will be taxable under PGBP. And if any other person is getting the money, it will be taxable under income from other sources. Okay, so this was the charging section. Now before going to the computation section, let us discuss about accounting aspect. So section 145 subsection 1 speaks about accounting, and it says that for PGBP and IFOS, that is profit and gains of business or profession and income from other sources, the assessee definitely needs to follow either of two methods of accounting. So what are the two methods of accounting? Cash system and mercantile system. Cash system means payment basis of accounting. Mercantile system means accrual basis of accounting. Payment basis and accrual basis. However, for two types of incomes, no need to follow method of accounting. For two types of incomes, no need to follow method of accounting. What are the two types? It is given in section 145B, and the two types of incomes are: number one, interest on compensation and enhanced compensation, and number two, subsidy or incentive etc. received from the government. So for these two types of incomes, they are always taxable on receipt basis. You need not see method of accounting, always taxable in receipt basis. Okay. Next, section 145 subsection 2. All the assessees have to follow compulsorily income computation disclosure standards, ICDS. They have to follow what? ICDS. It is nothing but accounting standard, but for income tax purposes. However, for CA intermediate, it is not there in the syllabus, so you need not worry much. Just know that all assessees have to follow ICDS. But who are the two types of assessee who need not follow ICDS? Number one, any individual or HUF who is not liable for tax audit under section 44AB need not follow ICDS. And number two, any assessee who is following the cash system of accounting also need not follow ICDS. Hence, ICDS is applicable only to mercantile system, not applicable to cash system. Okay. Now let us come to section 44AA, compulsorily maintaining books of accounts. First and foremost, if at all you are required to maintain books of accounts, for how much time you should maintain books of accounts? Answer is maintain the assessment year books of accounts, maintain the previous year books of accounts, and 6 years preceding the previous year also we have to maintain the books of accounts. Next, section 44AA subsection 1 gives a list of the professionals, and those professionals are compulsorily required to maintain books of accounts. Who are the professionals? Number 1, legal, then medical, engineering, architecture, accountancy, which includes chartered accountancy, technical consultancy, interior decoration, film artist, and director, actor, singer, composer, all are there in film artist. Okay, company secretary and information technology profession. Let me repeat it once again: legal, medical, engineering, architecture, accountancy, technical consultancy, interior decoration, film artist, company secretary, and information technology profession. So all these are professionals who are compulsorily required to maintain their books of accounts. Then section 44AA subsection 2. Apart from these professionals, who and all are compulsorily required to maintain books? Let us see. First and foremost, let us talk about individual and HUF. So if individual or HUF who is having an existing business, means the business which was there in the previous year or before the previous year itself it was started. Okay, then for such business, if the income is more than 2,50,000 or turnover is more than 25 lakhs in any of the three preceding previous years, in any of the three preceding previous years, that means even if one is satisfied, then that individual or HUF is compulsorily required to maintain books of accounts. And then if it is a new business or profession, what is new business or profession? It means that business or profession started during the previous year itself. In such case, if the income is likely to exceed 2,50,000 or turnover is likely to exceed 25 lakhs, then also the assessee has to compulsorily maintain books of accounts. Okay. Next, for all the assessees other than individual or HUF, what is the limit? If the income is more than 1,20,000 or turnover is more than 10 lakhs in any of the three preceding previous years, in such case they should compulsorily maintain books. And if it's a new business or profession, if income likely to be more than 1,20,000 or turnover is likely to be more than 10 lakhs in the previous year, then also they have to compulsorily maintain books of accounts. Next, if a person has violated or is showing less than the presumptive income under section 44 ADA, section 44 AE or section 44 AD, then also they have to compulsorily maintain books of accounts. And not only that, if a person has come out of 44 AD, then for the next 5 years also he has to compulsorily maintain books of accounts. Okay, now comes the question, what books of accounts should be maintained by the assessee? Answer is such books of accounts which will enable the assessing officer to determine the total income. What are the books of accounts? Such books of accounts which will enable the assessing officer to determine the total income. However, if for all the professionals referred under section 44 AA subsection 1, that is what? Legal, medical, engineering, accountancy, all those professionals, okay, if at all their gross receipts is more than 1,50,000 in all the three preceding previous years, or in new case of new business or profession it is likely to exceed 1,50,000, in such case such professional should maintain prescribed books of accounts. Okay, be clear with the difference. Generally, all the professions should compulsorily maintain books of accounts. Such books of accounts which will enable the assessing officer to determine the total income. However, if in all the three preceding previous years, okay, if in all the three preceding previous years the income is more than 1 lakh, gross receipts is more than 1,50,000, or in case of new profession the gross receipts is likely to exceed 1,50,000, in such case they should maintain prescribed books of accounts. What are the prescribed books? It is given under rule 6F, and the prescribed books are cash book, journal, ledger, all the sale bills more than 25 rupees, and all the purchase and expense vouchers more than 50 rupees. Okay. Apart from that, if a professional is a medical professional, he also should maintain all the above plus a daily case register, of which the format is given in form 3C, and inventory of medicines as on the first day and last day of the previous year. Okay. Now comes the question, sir, where to maintain the books of accounts? Answer very simple. Maintain in the principal place of business. Maintain books of accounts in the principal place of business. Now let us talk about the computation section. We have finished the charging section. Now let's come to computation section. Computation section is given under section 29, and it is very simple. Computation section of PGBP tells that follow section number 30 to section number 43D. What should we do? Follow section 30 to section 43D. That's it. Now let me talk about an important concept. Okay, in PGBP, see Kanna, certain incomes are allowed as deduction, certain incomes are not allowed as deduction. Okay, so there are two methods, main methods by which they can ask you a PGBP question. One is what? Direct method, and one is what? Indirect method. In direct method, what will happen? The question will give you a list of incomes and it will also give you a list of expenses. So whatever income is taxable under PGBP, you add them. Whatever expenses can be claimed as deduction, you reduce them. Then you will get the income under PGBP. But this is very simple. Hence, institute generally asks the tougher method, and that is indirect method. In indirect method, what will happen? The exam question will give you net profit, and from that net profit you have to do reverse calculation to find out the PGBP income. Reverse calculation. Now listen very carefully, very important, because here you can make silly mistake. So how to do reverse calculation, sir? Number one, firstly, let us see all the transaction. So let's say A is a transaction where the income as per P&L account is 70,000, but as per income tax it is an exempt income. So what should we do? If in P&L account it is given as income, it means it would have been added in the profit, correct? It would have been added while finding out the net profit. But in income tax it is not considered as an income. So now what you should do? You should reduce it from the net profit. Hence you should reduce that 70,000 from the net profit. Then next, B. B is a transaction of 50,000 rupees. It is considered as income under PGBP and it is also taxable under income tax law. See, if a transaction is an income under profit and loss account and is also taxable under income tax law, then what you have to do? You need not do anything, because while calculating the 65,000 net profit, already it has been considered as an income. Hence, what you should do? Ignore such transaction. Fine. Next. Now let's come to transaction C. Transaction C is a income of 20,000 as per profit and loss account, but in income tax law 25,000 is taxable under PGBP. Hence, since while finding the profit 20,000 has already been considered as income, so now what you should do? The remaining 5,000 rupees you consider it as an income now. Hence 5,000 rupees you add it to the net profit. Next transaction, transaction D. Transaction D is an income of 30,000 as per P&L account, and as per income tax only 10,000 is taxable in PGBP. So in P&L income is how much? 30,000. As per PGBP income is how much? 10,000. So the difference of 20,000, what you should do? You should reduce it. You should reduce it, because 30,000 has been added, but you should add only 10,000 in PGBP. That is why reverse the 20,000. Hence reduce the 20,000. You get my point? Next, there is an item E which is 5,000 in the profit and loss account, but in PGBP it is not taxable. It is taxable in income from other sources. That is why what you should do? Reduce that 5,000 from net profit, okay, while calculating PGBP income, and add that income in income from other sources head of income. Fine. Next, transaction F. Transaction F is a transaction that is taxable under PGBP, but it is not mentioned in the P&L account. Since it is not mentioned in the P&L account, it will not be present in the net profit. So now what you have to do? You have to add it to the net profit, since it is a taxable income. Okay. Next, let us see transaction T. Transaction T is a allowed expenditure of 15,000, but it is nowhere mentioned in the profit and loss account. Since it is not mentioned in the profit and loss account, it would not have been reduced while calculating the net profit. So now what you have to do? You reduce it. Since already it was not reduced, so now you reduce it to find out the PGBP income. Next, transaction number V. Transaction V is a expense of 5,000 which is there in profit and loss account. However, this expense is allowed as a deduction in capital gains chapter and not PGBP chapter. So now what you have to do? Add it back from the profit in PGBP and reduce it as a deduction under capital gain chapter. Next, transaction W. Transaction W is a item of 10,000 in P&L account. However, in income tax, it is not allowed as deduction. Not allowed as deduction. Since it is not allowed as deduction, so now what you have to do? You add it back. You add it back. Fine. You have to reverse the transaction. Hence, you add it back. Transaction X is an expense of 25,000 in the profit and loss account. However, only 10,000 is allowed as PGBP. 20,000 has been reduced while finding the net profit, but you should reduce how much? Only 10,000. So balance 15,000, you add it back to reverse the transaction. You get my point? Next, transaction Y. Transaction Y is a 30,000 expense in P&L account, and the same 30,000 is also allowed as an expense in PGBP chapter. So now what you have to do? You need not do anything. Just ignore it. Just ignore it, because while finding the net profit, already it has been reduced. Okay. Next, transaction Z. Transaction Z is 40,000 as per profit and loss account. However, 50,000 is allowed as deduction under PGBP. Hence, while finding the net profit, 40,000 has been reduced. But in PGBP, how much you should reduce? 50,000. So extra 10,000 is there, no? That you reduce now. Already 40,000 has been reduced, so 10,000 more you reduce now. So after doing all these adjustment, you will get the PGBP income. This is called indirect method, and I have told you all these transactions because I don't want you to do silly mistake in the examination. Okay, you will know all the provisions, dear, but if you go to the examination hall and if you are not able to do this calculation properly, then learning all the entire provisions is a waste of time. Okay, so be thorough in this method as to how to calculate the PGBP income. Now let us come back to the computation provisions. Firstly, let us talk about deductions, and the first deduction that we are going to learn is section number 30. Section number 30 talks about rent, rates and taxes, repairs and insurance done to building. Insurance done to building. So who will get the expenditure deduction? The owner of the building will get the expense as deduction, or the tenant will get? Answer is whoever is spending the money will get the deduction. Let it be owner or let it be tenant. It does not matter. But what are the rules? Number one, the building must be used for business. Building must be used for business. Rule number two, if it is partly used for business or partly used for other purpose, then allow the proportionate expenditure in PGBP. Okay, the proportionate expenditure which relates to business will only be allowed under PGBP. Next, if it is a sublet premises. Sublet premises means what? If we take a building on rent and the same building we are giving to some other person on rent, this is called subletting or subtenancy. In such case, the net amount of rent, if it is positive amount, it will be taxable under PGBP. It will be deduction under PGBP. If it is negative, treat it as an income under PGBP. The net amount will be treated as income or expenditure as the case may be. Okay, if the rent received is more than the rent that is paid, then the net amount will be income. If the rent paid is more than the rent received, then the net amount will be considered as expense. Okay, now you cannot give rent to your own self. If you are paying rent to your own self, then it is not allowed as deduction under PGBP. Similarly, rent received from myself, okay, will not be considered as income under income from house property also. Next, partners premises. If a partnership firm is paying rent to the partner, then only reasonable rent will be allowed as deduction. Excessive rent will not be allowed as deduction. Next, if a capital expenditure is incurred, then increase the capital expenditure in the cost of the asset and you claim the depreciation on the enhanced cost. You cannot directly claim it as deduction. You get my point? However, if a tenant is making capital expenditure, he cannot claim deduction, correct? Then what to do? If a tenant is making a capital expenditure, that capital expenditure will be considered as deemed building, and on such deemed building he can claim depreciation. Okay, as usual. You get my point? Next, let us see section number 31. Section 31 speaks about repairs and insurance of plant and machinery and furniture. Repairs and insurance of plant and machinery and furniture. Sir, what about rent and rates and taxes? They are covered in section number 37. They are not covered here. Okay, so repairs and insurance of machinery, plant and furniture. Here also, as usual, only if the asset is used for business, it will be allowed as deduction. Next, if it is partly used for business and partly used for other purposes, then only the proportionate amount which is used for business will be allowed as deduction. Then, if it is a repair, okay, then renovation is only allowed as deduction. Replacement or reconstruction is considered as capital expenditure and hence not allowed as deduction. So what about capital expenditure? Since capital expenditure is not allowed as deduction, it can be added to the cost of the plant and machinery, and on the added cost you can claim depreciation. You can claim depreciation. Fine. Now let us talk about the most biggest section in the PGBP chapter, that is depreciation. Section number 32 speaks about depreciation. To claim depreciation under the Income Tax Act, you have to satisfy three major conditions. What are the conditions? Condition number 1, assessee should be the owner of the asset. Condition number 2, the asset should be used for business or profession. And condition number 3, the asset should be a depreciable asset. Asset should be a depreciable asset. Now, for the owner, let us see a few points. First and foremost, lessor. In case of a lease transaction, let it be finance lease or operating lease, it does not matter. In a lease transaction, the lessor is only the owner of the asset, hence the lessor gets the benefit of depreciation. Next, if I am only having a part ownership in a building, then in my part only the depreciation is going to be allowed. Not only building, in any depreciable asset. If I am owning only a part of the asset, then only on my part I can claim depreciation. Next, building owner need not be the owner of the land. If the land owner is separate, building owner is separate, we are concerned only about the owner of building, because depreciation is only allowed on building. It is not allowed on the land. Okay. Next, depreciation is allowed even if the owner is not the user. Hence, even if my asset is given on hire or lease to someone else, still it will be considered as usage for the purpose of business and I will get the depreciation. Okay. Next, asset should be used for business or profession, and use includes passive use also. Even in the previous sections, deduction includes usage even if the usage is for passive use. What is passive use? Passive use means not actively using the asset. It means even if the asset is present in the business, it will be considered as usage. For example, fire extinguisher, tools and spares, and standby machinery, standby plant and machinery. Next, if an asset is used for partly business, partly other purpose, then allow the proportionate depreciation. Allow only the proportionate depreciation. However, only such proportionate depreciation should be reduced from the cost of the asset. Reduced from cost of the asset. So it means what? It means, for example, if you are having a plant and machinery of 1 lakh rupees, okay, and let's say building of 1 lakh rupees. So what is the depreciation? 10,000. Let's say the building only 40% is used for business. So how much is allowed depreciation? It is 4,000. Okay, this 4,000 only you should reduce from the cost of the asset. So 1 lakh minus 4,000 depreciation. Okay, what will be the closing WDV? It will be 96,000. You get my point? I hope you are clear. Now let us come to the third condition. Okay, and it is that asset should be a depreciable asset. The asset should be depreciable asset. Okay, now what is depreciable asset? Depreciable asset can be of two types. One is tangible asset and number two is intangible assets. There are three classes of tangible asset. Class number 1 is called building, class number 2 is called plant and machinery, and class number 3 is called furniture. So building, plant and machinery and furniture. Then class number 4, intangible asset itself, is class number 4, and intangible asset includes know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial right of similar nature. Okay, not being goodwill of business or profession. Not being goodwill of business or profession. See Kanna, what is not a capital asset? Know-how, patent, copyright. What is an intangible asset? Sorry, what is an intangible asset? Know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial right of similar nature, but not being goodwill of business or profession. Hence, goodwill of business or goodwill of profession will not be considered as intangible asset, Since it is not intangible asset, it is not a depreciable asset. Since it is not a depreciable asset, the assessee cannot claim depreciation on goodwill. Cannot claim depreciation of goodwill. This is a new provision. Okay. Now let us come to calculation of depreciation. How to calculate depreciation, Kanna? Firstly, you have to see what is the business of the assessee. Whether the assessee is engaged in the business of generation or generation and distribution of power. Okay. If at all the assessee is engaged in the business of generation or generation and distribution of power, then the assessee has an option to choose between straight line method and WDV method. Straight line and WDV. All the other assessees have to compulsorily choose only WDV method, written down value method. Now in straight line method, it is a separate asset system, which means it is a normal system. Depreciation is calculated for each and every asset separately. Okay. Then how to calculate depreciation? Very simple. Depreciation is equal to depreciation rate into actual cost multiplied by actual cost. Okay. However, since straight line method is not a very popular method, that is why the depreciation rate you need not memorize. The institute will give it to you in the question itself. Institute will give in the question itself. Now let's come to WDV method. In WDV method, what system is followed? Answer is block of asset system is followed. Block of asset system. Sir, what is this block of asset system? Block of asset means all the asset belonging to a same class and same rate. Same class and same rate. What is class? Class we have already seen. There are 4 classes of asset. What are the 4 classes? Building, plant and machinery, furniture and intangible assets. So there are 4 classes. Now let's come to what is the rate of depreciation for WDV method. Rate of depreciation for WDV method, let us study. Firstly, let us talk about building. The rate of depreciation for building used for residential purpose but other than hotel or boarding house is how much? 5%. Then what about not for residential purpose? If it is not used for residential purpose, which means what? It is used for commercial purpose, then the rate of depreciation is 10%. And for hotel and boarding house also, rate of depreciation is what? 10%. Next, if the building is used for a water supply project or water treatment system, or if the building is any temporary erection, then in such case the rate of depreciation is 40%. Next class, for furniture, and furniture includes electrical fittings. Okay, wiring, switches, etc. are also included in furniture. So what is rate of depreciation for furniture? It is 10%. Next, for plant and machinery, the general rate of depreciation is 15%. General rate is what? 15%. However, if a plant and machinery is a motor car, in such case the rate of depreciation is 15%. But if the motor car was purchased and used between 23rd of August 2019 till 31st of March 2020, then on such car alone the rate of depreciation is how much? 30%. Next, let us talk about motor vehicles given on hire. So if a motor vehicle, which means what? Motor car, then tempo, truck, lorry, etc. Whatever it may be, if it is given on hire, then normally the rate of depreciation is how much? 30%. However, if the motor vehicle was acquired and used between 23rd of August 2019 till 31st of March 2020, then the rate of depreciation is 45%. 45%. And this higher rate of depreciation is there, no? For this 23rd of August till 31st of March, this is not only in the first year. For each and every year, this higher rate of depreciation is allowed as deduction. Okay. Next, for ships and boats, the rate of depreciation is 20%. For molds that are used in rubber factory or plastic goods factory, it is 30%. For semiconductor industry, plant and machinery, rate of depreciation is 30%. For a computer, and computer not only includes computer includes scanner, software, laptop, printer, CPU, okay, mouse, keyboard, everything is included in the meaning of computer. So for the computer, rate of depreciation is 40%. For life-saving medical equipment also it is 40%. For pollution control equipment it is 40%. For windmill or generator on wind energy it is 40%. For aeroplane or aero engine also it is 40%. Then for a water supply project or water treatment system, if it is a building also 40%, if it is a plant and machinery also 40%. Then books are also covered in the meaning of plant and machinery, and that is why rate of depreciation is 40%. Now let's come to intangible asset. So class 4 is intangible asset. Rate of depreciation for intangible asset is 25%. Now listen very carefully, Gana. See, there is computer, okay, and there is books. Can computer and books, both of them together, come in a single block? Answer is yes, because computer is also plant and machinery at 40% depreciation. Book is also plant and machinery at 40% depreciation. So both are considered a single block. Add all of them together and find the depreciation separately. Okay. Now let me ask you one more question. Can commercial building and furniture be considered as same block? See, furniture is there and then commercial building is there. Depreciation on furniture is how much? 10%. Depreciation on commercial building is how much? 10%. Now can both of them be combined into a same block? Answer is no, because furniture is a different class and building is a different class. So class also should be same, depreciation rate also should be same. If both are same, all the assets can be combined to a single block and find out the depreciation only for the block of the asset. Block of the asset. Okay, one second. Now see, listen. See Kana, depreciation is mandatory. Depreciation is mandatory. So whether or not you claim depreciation as deduction, you definitely have to reduce the value of depreciation from the WDV of the fixed asset year after year. I told you that while calculating presumptive income, we do not get the benefit of depreciation deduction because all the deductions are deemed to be allowed. Then in such case, should we reduce the value of fixed asset? Answer is yes. Okay. Next, no depreciation is given on land and no depreciation is given on goodwill of business or profession, because both are considered to be appreciating and not depreciating. Okay, this third line is there. If at all this is there in the material, please cut it. Next, what about plant? What is the meaning of plant? Plant includes, it means generally what you are thinking as plant and machinery, that is definitely plant and machinery. Apart from that, ships, books, vehicles, okay, scientific apparatus, surgical equipment is also plant and machinery. However, plant and machinery does not include tea bushes, livestock, building, furniture, animals, human body and stock. So what is included? Ships, books, vehicles, scientific apparatus and surgical equipment is included. What is not included? Tea bushes, livestock, building, furniture, animals, human body and stock not included. Building also, what generally you consider as building, that is definitely building. Apart from that, road is also considered as building, bridges also considered as building, culverts, wells and tube wells. So all of these are also considered as building. Okay, and after that also, if a capital expenditure is incurred by tenant, that is also considered as deemed building, which I already told you. Okay, now see, goodwill of business or profession is not eligible for depreciation from previous year 2021 onwards. That is from 1/4/2020, assessee cannot claim depreciation on goodwill of business or profession. Okay. Now let's come back to the chart. See, what did I tell you? What is a block of asset? Block of asset means all the assets of a same class and same rate. So now how to calculate the depreciation? Depreciation is equal to depreciation rate multiplied by actual cost. Depreciation rate into actual cost or WDV as the case may be. So first year means you have to put the rate on the actual cost. After the first year you have to put the rate on the WDV. Fine. That is the depreciation. We have discussed in detail what is the depreciation rate. Now let us discuss what is actual cost. Actual cost. So what is actual cost, Kanna? Number one second. Any amount paid to purchase the asset will be called actual cost. Correct? Purchase price is only generally actual cost. Apart from that, see, listen. Trial run expenditure. If any trial run is done on the capital asset, then increase the value of trial run expenditure on the actual cost, reduce the value of trial run income from the actual cost. Then if there are taxes paid on that particular asset and if no credit is available, then include it in the cost. Fine. I told you if GST credit is available, don't include it. If credit is not available, include it in the cost. Next, if interest is paid on the loan for taking the fixed asset. So if for buying that depreciable asset, if you have taken a loan, then the interest that you pay on the loan should be added to the value of the depreciable asset till that asset is put to use. So till the asset is put to use, add the interest to the cost. After the asset is put to use, claim the interest as deduction. Claim the interest as deduction. Next, if there is any subsidy received from the government or any other person, then reduce it from the value of the cost. Reduce it from the value of cost. One more thing, if at all you are receiving subsidy for multiple assets together, then proportionately reduce the value of all the assets. Okay. Next, if any payment, okay, is made to a person in a day exceeding 10,000 rupees in any mode other than account pay check, account pay bank draft, electronic clearing system, or any other prescribed modes. What is this any other prescribed modes? Any other prescribed modes means, listen, any other prescribed mode means credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT, and Bhim Aadhaar Pay. So, in what and all payment modes is accepted? If a payment is made over 10,000, exact 10,000 not counted. Only if it is exceeding 10,000 you have to check. Okay, if it is up to 10,000 it is allowed karna. If it is exceeding 10,000, then if the payment is made to a person in a day in any mode other than account pay check, account pay bank draft, or electronic clearing system, or any other prescribed mode, then such payment should not be included in the cost of the asset. You get my point? So by doing all these transactions calculation, you will find out the value of the actual cost. On this actual cost value only you have to find out the depreciation. Now there are some special cases also which are relating to actual cost. Let us see those special cases quickly. First is special case. Okay, asset is used for business after it is used for scientific research. So after using for scientific research, if you are converting the scientific research asset into business, then the actual cost will be reduced by the scientific research deduction claimed. So basically if you claimed a deduction of 100 lakhs on the assets whose value was 100 lakhs, then the cost of the asset will become 0. Okay. Next, inventory converted into capital asset and used for business or profession. So if I converted my stock into my capital asset, in such case the fair market value on the date of conversion will be considered as the cost of the capital asset. However, the difference between the cost and the fair market value will be considered as PGBP income. So for example, if I am having a building and I am a builder, so for a builder, building is a stock, correct? So I have constructed this building for 80 lakh rupees. However, now I am converting this building into my capital asset for 1 crore, because the fair market value was how much? 1 crore. Hence 1 crore will be considered as the cost of the capital asset. However, the difference between this 1 crore and 80 lakhs, that is 20 lakhs, will be considered as my PGBP income. PGBP income. Next, asset is acquired by way of gift or will or inheritance. So if asset is received by gift or inheritance, in such case the cost will be the cost of the previous owner minus the depreciation that would have been allowable. Okay, would have been allowable to the assessee as if the asset was the only asset in the relevant block of asset. So firstly take the cost of the previous owner. Okay, for example it is 1 crore, then take the cost as 1 crore, then reduce the depreciation that would have been allowed every year. Then after that whatever value you get will be the cost for your business, will be the cost of capital asset. However, if you are also incurring any expenditure, let's say any expenditure for freight or installation, for example 2 lakhs, then that also should be included in the cost. So if you are receiving any asset by way of gift or inheritance, then the cost is the cost of previous owner minus the depreciation that would have been allowed. And also if an assessee is spending his own money for the purpose of freight or installation etc., then also he can add it to the cost. Next, second hand asset. Second hand asset, I told you in class that when I am purchasing a second hand asset, I can do a fraud. Okay, so that is why what will happen, the assessing officer is having the power. So for example, if I am purchasing a second hand asset for 50 lakh rupees, but the assessing officer thinks that the value of the asset is only 10 lakh rupees, so what he will do, he will take permission from the joint commissioner and he will change the value of the asset from 50 lakhs to 10 lakhs if he thinks that I am doing a fraud. Okay, so assessing officer is having the power with the permission of joint commissioner. Now let us see reacquisition of asset. Reacquisition of asset means what? I am selling my own asset and then buying it back from the person from whom I have sold. For example, I sold an asset of WDV 2 lakh rupees and I sold it for 2 lakhs and I bought it back for 10 lakhs. So now can I start claiming depreciation on 10 lakh rupees, which is my purchase price? Answer is no, because this section is telling that 10 lakhs or 2 lakhs, whichever is lower, will be considered as my cost. So what is given? Actual cost will be the actual cost when he first acquired minus the depreciation allowable, or the actual price for which the asset is reacquired, whichever is less. Okay, so in my case 2 lakhs or 10 lakhs, my existing WDV, or 10 lakh rupees, the price for which I have purchased, whichever is lower will be considered as my cost. Okay, next, acquisition of asset previously owned by any person to whom such asset is given or on lease or hire or otherwise. See now, listen. Now there is a person B who has sold an asset to person A for 55,000 and then got it back for lease. Got it back for lease from A. Okay. However, in the hands of B, the WDV of that asset was 50,000. WDV was 50,000. So in the hands of A, now what is going to be the cost? A is who? New owner. A is the new owner of the asset. Now the cost in the hands of A will be 50,000, which is what? WDV in the hands of B. Okay, listen one more time. If B is giving an asset to A and then the same asset he has got on lease from A. So now who is the new owner? A is the new owner. Okay. So what will be the cost in the hands of A? Answer is cost in the hands of A will be WDV in the hands of B, which is 50,000. You get my point? That is the answer. Now let us come to next provision. Building previously the property of an assessee. So if I am having a building which is an old building and now I have started using the building for the purpose of my business, then will it become a depreciable asset? Answer is yes. So now what will be the cost of such building? Answer is cost of the building will be the cost to purchase the building minus the depreciation that would have been allowed otherwise. So what I will do, if I had purchased the building in 1819, then reduce the depreciation for 1819, 1920 and 2021. Then what is the balance amount? That is 72.9. This only will be considered as the cost of the building in my business in previous year 21-22. You get my point? Like this similar provision only we studied for asset received as gift or inheritance. Okay, similar provision. But listen very carefully, this provision is there, no, this is applicable only for building, it is not applicable for any other asset. Hence we have seen a question also. For example, I am having a car of 5,25,000 and I purchased this car 3 years back. Now in the current year, previous year 21-22, I am bringing this car into my business. So what will be the cost of the car? The cost of the car will be 5,25,000 only, as usual. So for building only you need to do this special calculation. For other than building you need not do this special calculation. Next, let us come to capitalization of interest paid. This we have already seen. Then this one also we have already seen. Subsidy also we have already seen. Next, any asset is acquired outside India by an assessee being a non-resident and such asset is brought by him to India. So for example, this provision is there, no, this is same as the building provision. So for example, if I am a non-resident and I am having an asset outside India, now I want to use that asset in the business in India. That is why I imported that asset. I took that asset from outside India and brought it to India. In such case, what will be the cost of the asset? Answer is, the cost of the asset will be the actual cost minus depreciation that would have been allowed. Same as building. So I have to see for how much I had purchased that plant and machinery or the asset. For example, there is a plant and machinery which I am bringing to India and starting to use for the purpose of business, and let's say it cost 1 crore. Okay, then I have to reduce the depreciation in the respective years from the year of purchase till the current year, and then what is the remaining value, that only I can take it as the cost in my business. Okay, I hope you are clear. Next, capital asset on which deduction is allowable under section 35 AD. So if in 35 AD deduction is already allowed for a capital asset, then cost of such asset in the business is going to be nil. Cost of asset is going to be nil. Now what if within 8 years itself a capital asset is transferred from specified business under 35 AD to a non-specified business? If an asset is transferred from specified business to a non-specified business, then what will happen? Then the cost of such asset will be the the actual cost minus depreciation that would have been allowed in the business. So this is also similar to that NRI calculation, okay, and building calculation. So what I should do, if there is an asset which I used for 35 AD specified business, and within 8 years if I am converting that asset to a normal business or non-specified business, in such case the cost of asset is going to be the actual cost minus depreciation that would have been allowed in the past years. So the net amount will become my cost. I hope you are clear with all these provisions of actual cost. Now let's come back to PGBP chapter. Okay, see, listen. Now let's come back to the chart of depreciation. See, in depreciation we learned in WDV method what is depreciation? The depreciation rate into the actual cost or WDV as the case may be. So now we have discussed in detail about the rate and we have discussed in detail about the cost. Now what will happen if all the assets cease to exist, or or the selling price of the block is more than the value of the block? Selling price of an asset is more than the value of the block. In such case, okay, listen. Okay, I'll repeat it once again. In case of depreciable asset, if the entire block of value is no more, if the entire block is no more, all the assets are either sold or destroyed or anything has happened to the assets, so now assets are no more, or if the selling price of an asset or a group of asset is more than the value of the block itself, in such case capital gains will arise. Capital gains will arise. This capital gains we are going to revise in the capital gain chapter. We will revise in the capital gain chapter. Similarly, in SLM method also either terminal depreciation or balancing charge or capital gain can arise, that we will be discussing in the capital gain chapter. Now let us see the concept of 180 days. So in depreciation as per income tax, do not calculate proportionate depreciation for the number of days it is used. We only do 180 days concept. It means what? If an asset is used for less than 180 days in the year of purchase, then half rate of depreciation. If the asset is used for 180 days or more, then full rate of depreciation. Very, very simple. So depreciation can either be half rate or full rate. If the asset is used for 180 days or more, full rate of depreciation. If the asset is used for less than 180 days in the year of purchase, then what? Half rate of depreciation. Okay, and be very, very careful. I have given it here in the year of purchase. So for example, see, listen Karna, if I have purchased a furniture in 31st of March, which is what? Previous year 2021. 31st of March 2021, which is previous year 2021, and then I have started using the furniture only on 1st of November in the year 21-22. So in the previous year I purchased, okay, and during 21-22 I have used it for less than 180 days. So in such case, what will be the rate of depreciation? Answer is, the rate of depreciation will be the full rate of depreciation, that is 10%. You get my point? So here don't get confused. Only in the same year if I am purchasing and using for less than 180 days, in such case half rate of depreciation. If I bought in the previous years itself and in the current year I am using it for less than 180 days, in such case full rate of depreciation. So here what? Full rate. Okay. If you want, you can pause the video, see this example, you will be getting an idea. Okay. Next. Now let's come to other concepts in depreciation and let us discuss additional depreciation. What is additional depreciation? See Kanna, first and foremost, the concept of additional depreciation is only allowed for WDV method. Okay, in straight line method, no additional depreciation is allowed. And one more thing, it is not allowed for any assessee who is opting for the new tax regime under section 115 BAC. Only for old tax regime it is applicable. Now, how to calculate additional depreciation? First and foremost, if the conditions are satisfied and if the asset is not covered in the exception, then you can claim additional depreciation of 20%. Okay, what are the condition? Number one, the asset should be a new plant and machinery. Asset should be new plant and machinery. Number two, assessee should be engaged in business of manufacture or production or generation, transmission or distribution of power. Okay, and manufacture includes printing and publishing. So what is the first condition? The asset should be a new plant and machinery. So for old plant and machinery, is additional depreciation allowed? Answer is no. For any asset other than plant and machinery, let's say building or furniture, is additional depreciation allowed? Answer is no. Okay, that is the first point you have to note. And then next point is that assessee should definitely be engaged in manufacturing or production or generation or transmission or distribution of power or printing and publishing. Only for these businesses additional depreciation is allowed. If not, it is not allowed. Now what are the exception? Exception number one, additional depreciation is not allowed for ship or aircraft. Number two, it is not allowed for a used plant and machinery, only allowed for new plant and machinery. Number three, it is not allowed if the plant and machinery is installed in the office premises or residential accommodation or guest house. Number 4, no additional depreciation for office appliances. Next, no additional depreciation for road transport vehicle. And last but not the least, any plant and machinery for which the entire cost is already allowed as deduction, for example under section 35 or 35 AD, then in such case no additional depreciation for such plant and machinery. I already told you, Income Tax Act gives benefit only one time for one amount. Okay, so if already deduction has been claimed in any other section like 35 or 35 AD, then on such asset depreciation or additional depreciation cannot be claimed. Additional depreciation cannot be claimed. Can depreciation be claimed? No. Depreciation also will not be claimed because the cost of the asset is going to become zero. We already learnt in actual cost concept. Fine. So this is the concept of additional depreciation. In additional depreciation also 180 days concept applies Karna. If the asset is used for less than 180 days in the year of purchase, provide half additional depreciation, that is 10% in the first year, and give remaining half, that is remaining 10% in the next year. Okay. However, if the asset is used for 180 days or more, provide the full depreciation in the first year itself. You get my point? Now, one more point. Additional depreciation is allowed only once. So this 20% extra is there, no? This can be claimed only in the first year. It is not going to be given year after year. It is given only one time. Fine. So that you be careful. Now let us see what happens to depreciation in case of succession. So if there is succession, what is succession Karna? Succession means if a firm or sole proprietorship has become a company, or if a private company or unlisted public company has become a LLP, or there is an amalgamation or demerger. These are the four cases of succession. So if a succession has happened, then what to do? Calculate the depreciation as if no succession has happened. First, calculate the depreciation in the normal way and then distribute the depreciation between the predecessor and successor based on the number of days actually used. based on the number of days actually used by them. Okay, very simple. Now let's come to hire purchase system. Hire purchase system. So there are two types of system. One is installment system and one is hire purchase system. Installment system means what? Ownership is transferred in the first installment itself. In such case, what to do? In such case, treat it as a normal transaction. The entire amount, that is the sum total of all the installments put together, will be considered as cost of the asset and start claiming depreciation from the first year itself. Okay. Next, what about hire purchase system? Hire purchase system is the system in which the ownership is transferred in the last installment. In such case, what you have to do? We have to take two components. One is depreciation and one is hire purchase deduction. How to calculate depreciation? Easy, Kanna. What? Take the purchase price. What is the purchase price? Value of asset on the agreement date. So for example, if I am buying a car worth rupees 2 lakhs, I am buying a car worth rupees 2 lakhs. Fine. However, I am paying an installment of 10,000 for 24 months to buy that car. 10,000 rupees as installment for 24 months to buy that car for 2 years. Now what to do? See, listen, this 2 lakh rupees will be considered as the value of the car, and on the 2 lakh rupees car value, I can start claiming the depreciation from the first year itself. Okay. Then what about hire purchase deduction? Okay. Hire purchase deduction is very simple. Put the total 2,40,000, okay, into number of years. See, what is the sum total of all the installments? 2,40,000 minus value of asset. What is the value of asset? 2 lakh rupees divided by number of years. So for 2 years, if an hire purchase is done, take the number of years. So you will get the amount, that is 20,000. 20,000 is the value of hire purchase deduction. You get my point? So very simple. What is hire purchase deduction? Sum of installments minus value of asset as on agreement date divided by number of years of agreement. Very simple. Now let's come to method to calculate the depreciation. What is the method of calculating depreciation? Very simple, Kanna. First and foremost, take the opening WDV, then add additions during the year and then reduce the sale during the year. You will find the net amount. This net amount is there, no? You divide into three parts. Part number 1, asset not put to use. Then part number 2, asset purchased and put to use for less than 180 days during the previous year. And also, if at all there is a sale which is happening out of less than 180-day purchase, that you reduce here itself. Okay. Generally, this is not given for interlevel, but still if it is given, you reduce it here itself. On this value, you provide half depreciation, and on the balance value, you provide full depreciation. You get my point? So divide into three parts. Number 1, not put to use. Not put to use means no depreciation. Then part number 2, put to use for less than 180 days in the year of purchase. So for that you have to provide half depreciation, and for the balancing amount you have to provide full depreciation. So add all of this together, you will get the total depreciation. Reduce total depreciation from the cost of the asset. Then also, if it is a new plant and machinery for an assessee who is engaged in manufacture, etc., then reduce the additional depreciation also from the cost of the asset. You get my point? So this is the method of calculating depreciation. After reducing depreciation, you will get the closing WDV. Firstly, let us start with section number 35. Section number 35 speaks about deduction that is given on expenditure incurred on scientific research. 35 is for scientific research. Scientific research can be of two types. One is in-house research and second one is contribution. What is in-house research, Kanna? If the assessee is himself doing the scientific research, it is called in-house research. Any assessee can claim the benefit of in-house research. And what is the deduction that is allowed? Number 1, revenue expenditure is fully allowed as deduction, and capital expenditure other than land also fully allowed as deduction. Revenue expense fully allowed, capital expense other than land fully allowed as deduction. And not only this, even prior period expenses allowed as deduction. First, what is prior period? Prior period means the period till 3 years from the commencement of business. 3 years before the commencement of business period is called prior period. During this period, if the assessee incurs any revenue expenditure in the form of salary or direct material, then 100% allowed as deduction. And then even capital expenditure other than land prior period also allowed as deduction. Now let us come to contribution. See Kanna, contribution is allowed as deduction only if the assessee is in the old tax regime. If the assessee has followed the new tax regime under section 115 BAC, then it is not allowed as deduction. Now let's come to what is the contribution. Contribution given to a notified and approved research association, university or college for scientific research or social statistical research, 100% will be allowed as deduction. Then if contribution is given to IIT, national laboratory, universities, etc., then also 100% is deduction. Then if scientific research expenditure is given to company which is registered in India with the objective of doing research, then also 100% amount is allowed as deduction. See Kana, I told you if the contribution is made, then it should be made to notified and approved research association, university or college. Now what happens if you have given the contribution and later on that approval was withdrawn? In such case, still deduction will be given, because deduction cannot be denied merely because approval was withdrawn after contribution. So while making the contribution, make sure that the organization is approved. Later on, it is not your problem. You can still claim the deduction. Now let us talk about sale of scientific research asset. Sale of scientific research asset. Okay. Now, if the scientific research asset is used in the business and then later on it is sold, then how to calculate PGBP income? PGBP is equal to selling price. Sorry, now what we are saying, without using in business. If without using in the business, scientific research asset is sold, that means it is just used for scientific research and later on it is sold. In such case, two types of income will arise: PGBP income and capital gain income. What is the PGBP income? PGBP income will be selling price or deduction that was claimed under section 35 earlier, whichever is lower. Then what will be the capital gain income? Capital gain income is equal to selling price minus cost price. However, capital gain will arise only if it is a positive figure. If it is a negative figure, then no capital gain. Okay. Now let us talk about scientific research asset which was used in the business and then later on it was sold. If at all scientific research asset is brought into the business, then add it to the block of the asset and the cost of such asset will become zero. It is nil. And when the asset is sold, follow section number 50. That is the section which talks about capital gain on depreciable assets. You get my point? So this was section number 35, scientific research. Now let us talk about 35D and 35DDA. 35D talks about preliminary expense. 35DDA talks about voluntary retirement scheme. Both these expenses fully are allowed as deduction for 5 years, in a period of 5 years. So preliminary expense as well as VRS expense, the entire amount, let's say the amount is 1 crore, then 20 lakh rupees, that is 1 crore divided by 5, will be allowed for 5 years continuously. Okay. Now what if while claiming the deduction in 5 years, in between there was any amalgamation, demerger or succession? In such case, the remaining deduction is allowed to the new undertaking. So which means what? After 2 years, let's say there was an amalgamation. Then for the first 2 years, old company will claim the deduction. For the remaining 3 years, new company will claim the deduction. You get my point? Now let us learn in detail about section 35D, which is preliminary expense. Preliminary expense. First and foremost, preliminary expense is allowed only to a resident. It is not allowed to a non-resident or a foreign company. That is point number 1. Then, see, listen. What is preliminary expense? Preliminary expense allowed as deduction will be actual expense, but the maximum limit will be what? 5% of the cost of project. Hence, actual preliminary expense up to a maximum of 5% of the cost of project will be allowed as deduction. That is why I have written 5% of cost of project or actual expense, whichever is lower. Now, what is actual expense? Actual expense means feasibility report preparation, project report preparation, conducting market survey, having engineering services, and then legal charges for drafting any agreement. What is actual expense? Feasibility report, project report, market survey, engineering services, and then legal charges for drafting agreements. So this is actual expense. Now what is cost of project? Cost of project means cost invested in the fixed asset of the new project. So whatever money is invested in the fixed asset, it is called cost of project. And the what is the upper limit? It is 5% of the cost of project. Now when it comes to Indian companies, they are having two more benefits for preliminary expenditure. So first benefit is what? First benefit is, as their upper limit, they can choose 5% of cost of project or 5% of capital employed. That is why I have written 5% of cost of project or 5% of capital employed, whichever is higher. Whichever is higher, or actual expense whichever is lower, will be allowed as deduction. Now what is this capital employed? Capital employed means issued share capital plus long term borrowings plus debentures on the last day of the commencement or extension. Issued share capital, long term borrowings and debentures on the last day of the year of commencement or extension. But this capital expenditure is capital employed is there, no, it will not include reserves and surplus and security premium. It does not include reserves and surplus, security premium. And what is the second benefit given to Indian company? Second benefit is that for a company, 5 more expenses are allowed as actual expense. What are they? Number 1, legal charges to draft the article of association and memorandum of association. Number 2, printing expenses relating to article of association and memorandum of association. Number 3, fees for registering the company under the Companies Act. Number 4, issue for public subscription or issue of debentures. And number 5, any other item as may be prescribed. Okay, so 5 extra actual expense allowed as deduction under section 35D. Okay.
Expenses. Now in preliminary expense also, one minor procedural change is there, Kanna. So what is that change? The change is that we have already learned that in case of this section, only certain expenses are allowed as deduction. What are those expenses? Feasibility report, project report, market survey, engineering services, and legal charges. So these 5 types of expenses are allowed as deduction. Certain other expenses are also allowed in case of company, that also we had discussed. Now in the first 4 expenses, no Kanna, feasibility report, project report, market survey and engineering services, earlier the deduction was given only if the prior permission is taken for making these expenses, or if CBDT has given approval to certain vendor and from that vendor you had purchased these relevant items or made the relevant expenditure. So it was a very tedious task for the income tax department, because each and every time it has to give approvals and permissions for incurring these expenditure. So now to get rid of that problem, what they have done, the government has, the Income Tax Act has introduced a self-declaration basis of getting the expenses deducted. What is that self-declaration basis? The assessee has to furnish a statement containing the particulars of the above expenditure within the prescribed period to the prescribed income tax authority in the prescribed form and prescribed manner. So now what they are telling, earlier what we used to do, let us see. Earlier, let's say Mr. A wants to claim preliminary expenses as deduction. So what he will do, he will go to the income tax department and he will tell that I want to make so and so expense. So either income tax department will give permission, or they would have already given permission or approval to a certain number of vendors, and they will tell that with these vendors you can do that expenditure. So each and every time the person has to go to the department and get the permission or approval for the expenses. Now no need for all this. Now what Mr. A has to do, Mr. A can directly incur the expense, and after incurring the expense, Mr. A should submit the details. The details can be submitted in the income tax portal itself in the login, and it should be submitted at least 1 month before the due date to file the return of income. So self declaration is enough, no prior approval is necessary. Please write here within 1 month before the due date to file the return of income. So the prescribed period is what? Before 1 month before the, within 1 month before the due date to file the return of income. For what expenses karna? Feasibility report, project report, market survey and engineering services.
Then 35D, one more last point, which is all these actual expenses should compulsorily be audited by a chartered accountant. Audited by a chartered accountant. So basically 35D means what? 35D means preliminary expense. Preliminary expense is a deduction which is not allowed for foreign companies and non-resident. It is allowed only for resident and Indian companies. Now how much amount is allowed? The entire amount is allowed subject to the limits which I am going to tell now, and it is allowed for 5 years. So the entire amount divided by 5, you have to apply it in 5 years consecutively. Now what is allowed as deduction? 5% of cost of project or actual expense, whichever is lower, is allowed as deduction. But for an Indian company, how you should calculate? 5% of cost of project or 5% capital employed, whichever is higher. Whichever is higher, or actual expense, whichever is lower, will be allowed as deduction. Now all the meanings you see yourself now. Now let's come to section number 36, which speaks about general deduction. General deduction. Firstly, let us talk about insurance premium on stock and stores. So if you have taken an insurance on stock, the premium is allowed. However, you have to make the premium you on payment basis. The premium is allowed only on payment basis. So only if you pay it during the year, it will be allowed as deduction. And now listen. Now coming to payment, let us first discuss section number 43B.
Section 43B, deduction on actual payment basis. This section contains a list of totally 9 deductions that are allowed as a deduction only if it is actually paid by the assessee. The first 8 are having different rules and the last one is a new provision that is having slightly different rules. So first let us study the first 8 types of deduction. Okay, so the first 8 deductions are allowed as a deduction only if it is actually paid by the assessee on or before the due date to file the return of income. If it is not paid, it is not allowed as deduction. If it is paid on or before the due date, it will be allowed as deduction in the same previous year. But if it is paid later on, then it will be allowed in that year. Let us understand this with the help of an example. Let's say in previous year 23-24, as on 31st of March 2024, the bonus payable to the employee was 1,50,000. Okay, and let us assume the due date for this assessee is 31st of July. The payment of 1 lakh rupees was made on 30th June and the payment of the balance 50,000 rupees was made on 30th of August. Okay, when is the due date? 31st of July. Fine. Since this payment of 1 lakh is made within the due date of filing return of income, this 1 lakh will be allowed as deduction in previous year 23-24 itself, or you can say assessment year 24-25. However, this balance 50,000 payment was made after the due date, hence this will be allowed in previous year 24-25 and assessment year 25-26. Now I hope you are able to get the point. So now let us discuss what are those different types of payments which are allowed only like this. Firstly, any tax, duty, cess or fee payable. So if there is any tax payable to the government, then it is allowed as a deduction only if it is paid on or before the due date to file the return of income. For example, you can claim STT, security transaction tax, as a deduction only if it is actually paid within the due date to file return of income. Next, there are 3 types of interest which is only allowed as deduction if it is actually paid within the due date. First is interest to scheduled bank or cooperative bank. Number 2, interest to public financial institutions like State Financial Corporation or State Industrial Investment Corporation. And number 3, interest to notified classes of NBFCs. So not all the NBFCs are covered here, only the NBFCs that are notified by the government are covered here. If it is notified, it will be given in the question, so don't worry. So 3 types of interest are covered in this section. Only if this interest is actually paid on or before the due date to file return of income, it will be allowed as deduction. And one special point is also there about this interest. See here Kanna, if this interest is not paid and is later converted to loan, the unpaid interest, if it is later converted to loan, then such interest will be allowed as deduction only if that loan is payable. So let me give you an example. Let's say an amount of 2 lakh rupees as interest was to be paid. Now this 2 lakh rupees, the assessee was not able to pay this interest, so the bank converted this 2 lakh also to a loan. Okay, now this interest of 2 lakh will be allowed as deduction only when this loan is repaid. So till this loan is repaid, this interest will not be allowed as deduction. In the year in which this loan is paid, the interest will be allowed as deduction. That is the special point. Then next 3 let us discuss. The 3 are related to employees. So what 3 deductions related to employees is allowed only if it is paid on or before the due date to file the return of income. First is bonus or commission paid to employees. Second is leave salary paid to employees. And third is employer contribution to welfare fund. For employee contribution, there is separate rules Kanna. Now we are talking only about the employer contribution. So bonus or commission, leave salary and employer contribution are allowed as deduction only if it is paid within the due date to file the return of income. Okay. Then payment made to railway authorities for reusing railway assets. It is allowed as deduction only if it is paid within the due date to file return of income. By putting this section, the central government is assuring that the Indian Railways will get their payments on time. Now last point, which is a slightly different point with slightly different rules, and it is a new provision, very important from the examination point of view. And it is sum payable to MSME, that is micro or small enterprise, not medium enterprise, only micro or small enterprise beyond the time limit as per MSMED Act. Okay, so the first 8 points that we discussed are allowed as deduction if it is actually paid on or before the due date to file return of income. However, these payments to micro or small enterprise will be allowed as deduction only if it is paid within the due date that is specified in the MSMED Act. Okay, so the assessee has to make the payment as per the due date of the MSMED Act. If it is paid within the due date, it is allowed as deduction. If it is not paid, it will not be allowed as deduction. If it is paid late, then it will be allowed in that year. Okay. So now first let us discuss what is micro and what is small enterprise. So micro and small enterprise firstly should only be manufacturers and service providers. What? Manufacturers and service providers. So traders are not included in micro and small enterprise. Next, the investment in their plant and machinery or equipment should be up to 10 crores and turnover should be up to 50 crores. Since both micro and small enterprise are covered in same provisions, that's why you just see whether the person to whom the payment is made is their investment in plant and machinery up to 10 crores and turnover is up to 50 crores. If it is covered, then the such enterprise will be covered under the micro or small enterprise and payment made to them should be within the due date specified in the MSMED Act of 2006. Now what is the due date of payment as per MSMED Act? See here, if assessee is making the payment for goods or services to a micro or small enterprise, then you should see whether there is an agreement or no agreement. If there is agreement, then the payment should be made within the date as per the agreement or 45 days, whichever is earlier. Date as per agreement or 45 days, whichever is earlier. And if there is no agreement, then the payment should be made within the 15 days time period. Okay, and from when should you start counting this number of days? You should start counting the days from the date of acceptance of goods or services or deemed acceptance of goods or services. Okay, so this is the MSMED Act provision. The first 8 are allowed as deduction only if it is paid within the due date to file the return of income, but the payment to micro or small enterprise who are manufacturer or service provider whose turnover should be within 50 crores and investment in plant and machinery should be within 10 crores, then the payment should be made within the time limit specified in the MSMED Act, which is 15 days or date of agreement or 45 days as the case may be. If the payment is made within the time limit, then amount is allowed as deduction. If payment is not made within the time limit, then if it is allowed as deduction in the year in which the payment is made. That is why I told you. Let me give you one small example. Let's say there is no agreement and the date on which the goods are accepted is 1st of January 2024. So in such case, the 15-day period will end within 15th of January 2024. Let's say the payment is made on 17th of January 2024. So is this payment within the due date as per MSMED Act? Answer is no. It is beyond the due date. However, the payment is made within 23-24 itself, That is why it will be allowed as deduction in 23-24. But what if the same payment is made on 1st of April 2024? In such case, it will not be allowed in 23-24, it will be allowed in 24-25. If you need more clarity on this section, please visit the amendment lecture that I have uploaded for May 2024 examination. There I have explained it in a crystal clear format. But since this is a revision lecture, I am completing this quickly.
Now let us discuss section number 36. See, first point is what? Insurance on stock. So if insurance is taken on stock, the premium will be allowed, but only on payment basis. See, here I have written payment basis. Payment basis means what? It should be paid within that year itself. If it is paid within the previous year itself, it will be allowed as deduction. Next, premium on life of cattle. Premium on life of cattle also only allowed on payment basis, means if you pay it will be allowed, if you do not pay it will not be allowed during the year, and it is allowed only to Federal Milk Cooperative Society. Okay, example Amul. It is allowed only to Federal Milk Cooperative Society. Next, employee health insurance premium. So if you are taking any health insurance for employees, then the premium amount is allowed as deduction. However, it is allowed only on payment basis. It means during the year itself you have to pay it. Fine. And it is payable, it is allowed if it is paid in any mode other than cash. So other than cash, in any mode it can be paid. Next, let us talk about salary related deductions. Number 1, bonus or commission. Bonus or commission is allowed as deduction. However, it is allowed on actual payment basis. Actual payment basis means what? Section 43B, which means that bonus or commission should be paid on or before the due date of filing return of income. Next, section number 36(1)(4), employer contribution to funds. So employer contribution is only allowed if the contribution is made to approved superannuation fund or approved gratuity fund or recognized provident fund or statutory provident fund or pension scheme under section 80 CCD. So what is allowed? Approved superannuation fund, approved gratuity fund, recognized provident fund, statutory provident fund and pension scheme under section 80 CCD. Only these are allowed as deduction to the employer. Moreover, the contribution to 80 CCD only up to a maximum of 10% of salary will be allowed as deduction. And what is salary? Salary means basic plus DA terms. Basic plus DA terms.
In section 36, I told you about 80 CCD subsection 2, that is employer contribution deduction has been increased from 10% limit to 14% limit, correct? The same change will reflect here also in section number 36. Even the employer will get a deduction of up to 14% of the salary.
So that is employer contribution that is allowed, and we already learned that employer contribution is allowed under section 43B on actual payment basis. It means the entire amount will be allowed as deduction only if it is paid on or before the due date to file the return of income. Okay, now let us talk about employee contribution. Employee contribution is allowed as a deduction only if it is paid on or before the due date of the respective fund. Okay, of the fund. For example, if there is a provident fund and for March month the due date is 15th of April, then only if it is paid on or before 15th of April it will be allowed as deduction. If not, it will not be allowed as deduction. Okay. Next, section number 36, subsection 1, clause 3, interest. Interest on borrowings is allowed as deduction only if the borrowings is used in the business. If borrowings is not used in the business, interest is not allowed as deduction. Sir, what if the loan is taken on a depreciable asset or a fixed asset? So in such case, the interest up to the asset is put to use, you add it to the cost of the asset. After the asset is put to use, that interest you claim as a deduction under section 36. Okay. Now let's talk about bad debts. Bad debts are allowed as deduction only if the bad debts have become irrecoverable, and moreover only if it was treated as an income earlier. I told you that sales would have been treated as a income earlier. That is why if the sundry debtors are becoming bad debts, then it will be allowed as deduction. However, loan given was not treated as income earlier. That is why if a loan will become bad debts, it will not be allowed as deduction. So only if it was treated as income earlier, it will be allowed. If not, it will not be allowed. Okay. Now let's talk about STT and CTT. What is STT? Security transaction tax. What is CTT? Commodity transaction tax. Both are allowed as deduction under PGBP, and they are allowed on actual payment basis because it is a tax. Tax is allowed on actual payment basis, means pay it on or before the due date to file the return of income. Okay, now be very careful. STT CTT is allowed in PGBP, but it is not allowed in capital gain. Okay, wa? Now let's talk about other deductions. Firstly, what is discount on zero coupon bonds? Discount on zero coupon bonds. So if zero coupon bonds are issued at a discount, then the discount value will be allowed proportionately as a deduction. Okay. So allowed on pro rata basis. So how to calculate the deduction? Total discount divided by total number of months, okay, of the bond into total number of months during the previous year. Total discount divided by total number of months of the bond multiplied by total number of months during the previous year. Now what is animal allowance? Animal allowance means if an animal is there, if it becomes useless or if the animal dies, in such case the actual cost incurred to buy that animal minus the selling price of the animal or the insurance claim received for the animal will be allowed as deduction. Next, promoting family planning. See, family planning is done by the individual, but promoting the family planning expense is allowed only to companies. It is allowed only to companies. If it is a revenue expenditure, fully allowed. If it is a capital expenditure, allowed in 5 equal annual installments. So this was section number 36. Now let us come to section 37. 37 tells that whatever expense is there, it is related to business, then it will be allowed. Okay. However, losses will not be allowed as deduction. Prior period expenses will not be allowed as deduction. Earlier we have discussed 2 or 3 places where prior period expense is allowed. Only there it will be allowed. Nowhere else it will be allowed as deduction. Okay. Personal expenses not allowed. Capital expenditure not allowed. Contingent liability also not allowed. So for example, if I am having provision for bad and doubtful debts, it will not be allowed as deduction. Next, premium on keyman insurance policy is allowed as deduction. Okay, it is allowed as deduction. Then any illegal expenditure will not be allowed as deduction. If I have paid any fine or penalty for a breach of law, it will not be allowed. So for example, if I have breached the pollution control law, it will not be allowed. If I have given any freebies to medical practitioner, it will not be allowed. Referral commissioner referral commission paid by laboratory to the doctors is also not allowed as deduction. However, if I breach a contract and then if I'm paying any money, then it is allowed as deduction. For example, I had given a lift. I had actually purchased the lift. For that I gave an advance. Now I broke the contract, so the advance was forfeited. Hence this advance money that I have paid will be for breach of contract and it will be allowed as deduction. So breach of law not allowed as deduction, breach of contract allowed as deduction. Okay.
In section number 37, now an explanation is added. What is section number 37 Kanna? It is the general deduction. That is, if any amount is there and that is spent for the purpose of business or profession, then that amount will be allowed as an expense. In that, I had taught you that any illegal expenditure will not be allowed as expense, okay, or will not be allowed as deduction. But in this now, an explanation has been added. What is the explanation? Number 1. There was a confusion whether if this illegal expenditure is not allowed if it is illegal in India, or also if it is illegal outside India it will not be allowed. Answer is, if the offense is prohibited by law in India or outside India, it will not be allowed as deduction. Hence, for example, if I am incurring an expenditure in USA and in USA if it is an illegal expenditure, then such expenditure will not be allowed as deduction. Okay. Point number 2. Providing benefit or perquisite where acceptance of such benefit or perquisite is a violation of law. This we had already discussed in class, but it is now also added as an explanation. And what is that? It means that if I am giving any benefit or perquisite to someone and the person, if they are receiving the benefit or perquisite, if that is a violation of law, then such expenditure will not be allowed. We discussed an example in class also. For example, a medicine company or pharma company is giving commission or perquisite. It can be commission, gift or anything they are giving to doctors. Okay, so for a medicine company, they giving commission is a business expenditure only. However, for doctors, it is illegal to accept such commission or perquisite. Hence, this commission or perquisite will not be allowed as deduction. You get my point? And next, to compound any offense in India or outside India. Okay, so if any amount is paid for compounding of offense, that also will not be allowed as deduction. Sir, what is compounding? Compounding means if you are doing any activities that is illegal but you are paying some extra money to make it legal, that is called compounding. So for example, if you are allowed to construct only 2500 square feet, okay, but you constructed 3000 square feet of building, correct? So what you did, 500 square feet extra you constructed, which was illegal, unapproved construction you did. But then what happened, you paid penalty of, let's say, rupees 1 lakh to make this 500 square feet as legal. This type of transaction is called compounding. So if something is illegal before, you are paying some extra money as fine to make it legal. It is called compounding. Such type of amount is also not allowed as expenditure. So these three types of amounts are not allowed as deduction under PGBP. This is the explanation under section 30.
CSR expenditure, that is corporate social responsibility, not allowed as deduction because it is considered as application of income. Then if contribution is made to political party, it is not allowed as deduction here. It will be allowed as deduction in the deduction chapter. Okay, wow. Then dividend paid is not allowed as deduction. Then even if any advertisement is made in the souvenir, brochure, pamphlet, newspaper, in etc. of a political party, then such advertisement expense also will not be allowed as deduction. Okay, even if it is related to the business. So now we saw till section number 37. Now let us start with the sections of disallowances. Disallowances means all the expenditure which will not be allowed as deduction. Firstly, let us discuss section 40 subsection A. Okay, so if payment is made outside India or within India to a non-resident without deducting the TDS, or the TDS is deducted but not paid within the due date to file the return of income, then in such case the amount of expenditure is fully disallowed. And similarly, if payment is made in India to a resident without deducting the TDS, or TDS is deducted but not paid within the due date to file return of income, then 30% of the expenditure is disallowed. Hence, if you are making a payment on which TDS is required to be deducted, then deduct the TDS and pay it to the government on or before due date to file the return of income. Only after that you should make payment to the person concerned. If you are not deducting the TDS or deducting but not depositing it to the government, in such case what will happen? The amount in case of non-resident receiver is fully disallowed. If you are paying to a resident, then 30% is disallowed. What if you have paid after the due date of filing return of income? In such case, in the respective year, that is in the year in which you have paid the TDS, will be allowed as deduction. And also, listen, if the payee, that is the person who is receiving the amount, has paid the taxes correctly, the payee has filed the return of income and also has given a CA certificate in which the CA has told, chartered accountant has told, that the amount has been received and the taxes have been paid correctly. In such case, if all these three conditions are satisfied, then the year in which such CA certificate is given, the amount will be allowed as deduction. So I am repeating once again, this is very important. If you are making any payment, if the assessee is making any payment on which TDS is required to be deducted, okay, in such case if the assessee has not deducted the TDS or not deducted but not deposited to the government within the due date to file the return of income, then if the payment is made to a non-resident, entire amount not allowed as deduction. If payment is made to a resident, then 30% is not allowed as deduction. Okay. However, if it is paid in the later years, then it will be allowed as a deduction in the later years. Similarly, if later on the person who is receiving the payment has paid the taxes correctly, has filed his return of income, and also is giving a chartered accountant certificate, in such case, in that year it will be allowed as deduction. You get my point? Next, any income tax is not allowed as deduction, or tax on PGBP or even interest on income tax is not allowed as deduction. Next, if state government undertaking is paying any money to the state government, then such money is not allowed as deduction. Then, if salary is payable outside India, then for sure TDS has to be deducted. If TDS is not deducted, then the salary is not allowed as deduction. Next, if the person is paying tax on non-monetary perquisites, then it is not allowed as deduction, because it is also not considered as income in the hands of employees. Okay. Next is section 40B series. 40B series talks about 40B series talks about interest on capital and remuneration given to partners of a partnership firm. Okay. Firstly, let us talk about interest on capital. What are the three rules? Number one, interest on capital is allowed only if it is authorized by the partnership deed. Number two, only if the authorization is after the date of the deed. And then number three, maximum 12% simple interest only allowed as deduction. So what are the three things? See Kana, actual interest or interest as per partnership deed, or 12%, whichever is lower, will be allowed as deduction. You get my point? Now let us come to remuneration given to partners. Remuneration only given to working partners will be allowed as deduction. If remuneration is given to other partners like sleeping partner, dormant partner, investing partner, etc., it is not allowed as deduction. Then remuneration is only allowed if it is written in the partnership deed, and if it is authorized after the date of the deed, and only if it is within the limits that I am going to mention below. What are the limits? See, firstly, you have to find out what is the book profit. Book profit is the net profit after the interest on capital but before partner salary. After interest on capital, before partner salary. Okay. Now,
So earlier, what were the limits? That if the book profit was up to 3 lakhs, the maximum amount of salary allowed will be 1,50,000 or 90%, whichever is higher, and the balance book profit 60% will be allowed. But now the limit has doubled. Instead of 3 lakhs, now it has become 6 lakhs, and instead of 1,50,000, now it has become 3 lakhs. So now when you calculate, you should calculate using the new limits.
now let's come to section 40 big A series. Section 40A subsection 2, related party transaction. If any payment is made to a related party, then unreasonable amount or excessive amount will not be allowed as deduction. Okay, hence only the reasonable amount or the fair amount will be allowed as deduction. Now, who are these related party? Related party can be a relative or an associate. For an individual, the relative means spouse, brothers, sister, lineal ascendant or lineal descendant. For other than individual, for a company, relative is a director and his relatives. For a partnership firm or LLP, the relative is a partner or his relatives. For an AOP, BOI or AJP, the relative will be a member or his relatives. And then, okay, that this much only. Next, what is an associate? An associate is a concern in which a person or a relative is having substantial interest. Substantial interest means what? 20% voting power or 20% profit sharing. 20% voting power in case of companies, or 20% profit sharing ratio in case of other than companies is called substantial interest. So, if I am having a substantial interest, or if I am having if I am a relative, in such case any expenditure made to a listen. So if I am making any payment to a related party, or if I am making a payment to any associate, in such case, if the payment is reasonable, it will be allowed. If it is unreasonable, only the reasonable part will be allowed as deduction. Excess amount will not be allowed as deduction. Now let's come to section 40A3, which is very, very important. If any payment above 10,000 rupees, okay, above 10,000, not exact 10,000, above 10,000 is made to a person in a day in any mode other than account pay check, account pay bank draft, electronic clearing system, or credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT, or Bhim Aadhaar Pay. So in any mode other than all these modes, then it will not be allowed as deduction. However, for the purpose of transport expense or freight expense, the limit is 35,000 and not 10,000. And if retirement benefit is given to employees, then the limit is 50,000 and not 10,000. However, if a transaction is covered in Rule 6DD, then you need not see this provision at all. What is Rule 6DD? It means if any payment is made to the government or RBI or cooperative banks or primary agricultural credit society or LIC. So if payment is made to all these people, in such case you can make unauthorized payments or unprescribed payments also. So to the government, if I want, I can pay 20,000 in cash also. It is not a problem. Okay. Or to RBI also I can pay the cash. To cooperative society, etc., cooperative banks, etc., I can pay the cash, not a problem. Next, if there is an employee who is posted in a place for 15 days or more with no bank or authorized dealer or money changer, in such case also payment of more than 10,000 is allowed as deduction, even if it is other than prescribed modes. Then if I am making a payment to my agent and my agent is making a payment in all the transaction which is covered in Rule 6DD, then me giving money to my agent is also allowed as is considered as payment under Rule 6DD. Fine. Next, payment by means of. So if I am making payment by means of letter of credit, mail or telegraphic transfer, bank account to bank account transaction, bill of exchange, or even book adjustment. Book adjustment means what? I have to give you 50,000, you have to give me 40,000. So I will set off the 40,000 and balance 10,000 only I will give you. This is called book adjustment. So this is also allowed even if it is not through prescribed modes. Next, if you are making any payment to purchase agricultural produce or forest produce, animal husbandry or dairy product, poultry farming, fish or fish products, horticulture or apiculture, or manufacturing in the cottage industry without using of power. In all these cases, if you are giving money to the producer, okay, that is direct farmer or producer, in such case the amount is allowed even if it is other than prescribed modes. But what if you are paying to any other person? For example, you are buying all these products from Amazon. In such case you have to pay only through prescribed modes. You get my point? Next, if a payment is made in a village or a town where there is no banking facility, there also payment can be made in any mode other than prescribed modes. It will be allowed as deduction. Now let's come to next disallowance. Provision for gratuity is allowed only if gratuity is actually payable. So if gratuity is actually going to be paid to the employees, provision will be allowed. If not, provision will not be allowed. Next, contribution for welfare funds other than those mentioned in section 36 will not be allowed as deduction. So what are other than those? For example, contribution to unrecognized provident fund not allowed. Contribution to unapproved superannuation fund not allowed as deduction. Like that. Okay. Now let's come to next provision, deemed profit. Deemed profit. What is deemed profit? There are four cases. Case number one, remission or cessation of trading liability. So, if there is any amount which was earlier treated as deduction, but now it cannot be treated as deduction, in such case, you have to make it a income. For example, last year in March, there was a rent payable that was 20,000. But in the previous year, what happened is that entire rent was paid in cash in a single day itself. In that case, since the amount is more than 10,000 to a person in a day in any mode other than prescribed modes, hence it will not be allowed as deduction. Correct? That is why what you have to do, Since you had treated this rent as expense in the preceding previous year, now treat it as an income in the previous year. This is only called remission or cessation of trading liability. It means any amount that was treated as expense earlier and now you realize that that will not be allowed as expense, hence now you should treat it as income to reverse the transaction. That is remission or cessation of trading liability. Next, balancing charge also in case of SLM assets will be allowed as deduction. Okay. Next, if a sale of capital asset is used, if a capital asset was used for scientific research and then sold, that is also deemed income. And then if bad debts were allowed as deduction and later on if they are recovered, then they will also be deemed as income. So very simple. Now let's come to section 44AB, that is tax audit. Tax audit is applicable to whom? Number 1. If the turnover of a business exceeds 100 lakh rupees, then tax audit is compulsory. However, this 100 lakhs or 1 crore will be considered as 10 crores if two conditions are satisfied. What are the two conditions? Number 1. Aggregate cash receipts is up to 5% of the total receipts during the previous year, and aggregate cash payments is up to 5% of the total payments during the previous year. Okay, if both these conditions are satisfied, then the limit will be 10 crores instead of 1 crore. Fine. Next, if gross receipts exceed 50 lakhs in case of profession, then such profession has to compulsorily get the tax audit done. Next, if the profit is lower than the presumptive income under section 44AE, 44ADA or 44AD, then also compulsorily do tax audit. Moreover, if 44AD has not been taken, okay, after taking it in the previous year, later on if 44AD has not been taken, then in such case for the next 5 years also compulsorily do tax audit. Okay. However, one relief is been given in case of 44AD and 44ADA. If the income itself is lower than the presumptive income itself is lower than basic exemption limit, then no need to do tax audit. Fine. Who will do tax audit? Answer is chartered accountant will do the tax audit. Next, what is the tax audit form? Form 3CA, 3CB and 3CD. If an organization or assessee is already subject to audit under any other act, in such case the form will be 3CA and 3CD. If the assessee is not subject to audit under any other law, then the audit form will be 3CB, 3CD. Okay. Now what is the due date for tax audit? Due date is 1 month prior to the due date of return of income under section 139 subsection 1. So what is the due date for return of income? It is 31st October. So what is 1 month before 31st of October? It is 30th of September. Hence due date for tax audit is what? 30th of September. Next, even in section 10AA, 35AD, 35D, 50B, 80JJAA and AMT, in all these sections also we will see that a chartered accountant report is compulsory. There also the due date will be 1 month prior to the due date of furnishing return of income. Okay. Now if tax audit is not done, what is the penalty? Penalty is 0.5% of turnover or 1,50,000, whichever is less. Now let's come to presumptive income. Firstly, let us discuss section number 44AD. Who is eligible for 44AD? Only a resident individual HUF and partnership firm, not being an LLP, are eligible for 44AD. So who is eligible? Resident individual HUF firm other than LLP. Okay, with a turnover of up to 2 crores. If turnover is more than 2 crores, a person cannot opt for 44AD.
But now there is a higher limit of up to 3 crores. So if the turnover is more than 2 crores and within 3 crores, then you have to satisfy one condition. What is the condition? The condition is that the total cash receipt should be within 5% of the total turnover or gross receipts. And in this case, even if there is a check or bank draft which is not an account pay check or not an account pay bank draft, then it will be considered as cash. Okay. So here I can also tell you total cash receipts plus, or you can, if you want, you can write this. Okay. Total cash receipts plus non-account payee check plus non-account payee bank draft. Should be within 5% of total turnover or total gross receipts during the year.
Now, if you have chosen the scheme of 44AD, you have to show presumptive rate of income. Presumptive rate means 8% in case of non-banking transaction and 6% in case of prescribed modes. So 6% in case of prescribed modes, 8% in case of other than prescribed modes. So for example, if my turnover is 1 crore 80 lakhs, okay, and if 1 crore is in prescribed modes, I will take 6% of 1 crore, and balance 80 lakhs which will not be in prescribed modes, I will take 8%. Then both of them I will add together and the total value will be called presumptive income. On this presumptive income, all the deductions are deemed to be allowed. No further deduction will be allowed. It means this is only the final profit. Okay. Now, what if the actual profit is higher than the deemed income itself? In such case, show that higher profit. Okay. Higher than the presumptive income itself. In such case, show the higher profit. So for example, let's say my presumptive income has come to 12 lakh 40,000, but actual profit is 13 lakhs. In such case, what I should show as presumptive income? Answer is 13 lakhs. If the actual profit itself is higher than the presumptive income, show the actual profit. That's what I'm trying to say. Next, all the deductions are deemed to be allowed. Okay, one second. Okay, all deductions are deemed to be allowed. No need to maintain books of accounts and audit. So if at all an assessee is choosing the presumptive income section of 44AD, then the assessee need not maintain books of accounts. Also, assessee need not get the books of accounts audited from a chartered accountant under 44AB. However, section 44AD will not be applicable to number 1, the persons who are eligible for other presumptive sections, that is 44ADA and 44AE. So if I am eligible for 44ADA, I cannot opt for 44AD, or if I am eligible for 44AE, then also I cannot opt for 44AD. Then if any assessee is getting an income of commission or brokerage, then also 44AD is not possible. So in the P&L account, if you are finding any commission income or brokerage income, don't choose 44AD. Then if an assessee is engaged in agency business, he also cannot opt for 44AD. And then last, if a person is showing lower profit for 44AD till 5 years after such year. So what is the clause? See Karna, if 44AD has been opted once, assessee has to compulsorily take it for 5 more years. If not, the scheme is not applicable for 5 more years. You get my point? So for example, in year 1 if I took 44AD, then in year 2, year 3, year 4, year 5 and year 6, compulsorily I should take 44AD again and again. If at all, I do not take it in between the year. For example, in year 5, I did not choose 44AD. Then what will happen? Then for 5 more years, that is year 6, 7, 8, 9 and 10, compulsorily I cannot go for 44AD. I have to get my books of accounts audited and also maintain the books of accounts compulsorily. Okay. Next, in 44AD there is one more benefit. Advance tax need to be paid only in one installment, that is at the year end. Okay. And if 44AD is not taken, however, if income is below the basic exemption limit, then no need to do tax audit. Okay. Now let's come to section 44ADA, which speaks about profession. Okay. Now here also there is an amendment. Who can opt for section 44ADA? Answer is resident individual or partnership firm other than LLP. Resident individual or partnership firm other than LLP. Hence now LLP cannot opt for 44ADA section. Okay.
In section 44ADA also, there is a higher limit of 75 lakhs. We have learned that the limit is 50 lakhs. Now, the assessee can also claim a higher limit of 75 lakhs if the total cash receipts is within 5% of the total turnover or gross receipts. In this case, there will be only gross receipts.
Who are covered under section 44AA can choose section 44 ADA. What is 44 ADA? 44 ADA tells that show a presumptive income of 50% of the gross receipts, okay, or such higher sum. If the actual profit is higher, then show the higher profit. If actual profit is lower, then show at least 50% as the profit. Then you can come in this 44 ADA section. After showing this presumptive income, all deductions are deemed to be allowed, means no further deduction will be allowed. If this presumptive income is chosen, then no need to maintain books of accounts, no need to do tax audit, okay. And then even for advance tax, only one installment needs to be paid at the year end, okay. If 44 ADA has not been chosen, what did I tell you? Tax audit is compulsory. However, if income itself is below basic exemption limit, then tax audit is not compulsory, okay. Next, let's talk about section 44 AE. Who can opt for section 44 AE? Any person who is the owner of goods carriages up to 10 vehicles at any time during the previous year. At any time during the previous year, maximum how many vehicles I should have? 10 vehicles. Only then I can come in this section. What if during the previous year I have 11 vehicles just for one day? Even if for one day alone I am having more than 10 vehicles, I cannot come in this section. Okay, that is the first point. Now let us see how to calculate presumptive income. Number one, we have to differentiate the vehicles between heavy vehicle and not heavy vehicle. So heavy vehicle means what? A vehicle whose gross vehicle weight is more than 12 tons or 12,000 kilos. Not heavy vehicle means gross weight is up to 12 tons or 12,000 kilos. Okay. Gross vehicle weight means vehicle weight plus load weight. Now, for heavy vehicle, how to calculate the presumptive income? It is 1000 per month per ton or part of a ton of vehicle weight. For not heavy vehicle, how to calculate? It is 7000 per month per vehicle. 7000 per vehicle per month. Then after finding both of them, add both of them together, you will get the total presumptive income. Okay. Now, for this 44A, there is one more benefit. What is the benefit? The benefit is that 40B is still allowed even after the deemed income, presumptive income. So, for example, if the presumptive income is 5 lakh rupees, after this 5 lakhs, I can again allow 40B. What is 40B? Interest on capital and remuneration paid by partner to the partnership firm. It can be allowed as deduction even after the presumptive income. Okay. If presumptive income is chosen, what to do? No need to account, don't need to maintain books of accounts, no need to get the tax audit done. Okay. That is the benefit. Now, here be very careful. Here usage is not considered, here ownership is considered. That is why even if I am having a truck, okay, and the truck I am not using at all during the year, still I have to calculate the presumptive income for that truck. You get my point? So ownership is only important, usage is not important in this section. Okay. I hope you are clear with the presumptive income section also. We are going to discuss about the special businesses. Firstly, let us start with speculative business. Sir, what is speculative business? Speculative business is a business where there is purchase or sale of commodities, including stocks and shares, without the delivery. So, if there is no delivery in the purchase or sale of commodities, stocks or shares, etc., then it is called speculative business. For example, intraday trading of shares, it comes under speculative business. It means a business which plays purely on price difference, that is speculation. Okay. Now, why is this speculation business special, sir? Because loss of the speculation business can be set off only against the profit of the speculation business, and speculation business can be carried, loss can be carried forward only for a period of 4 years, which you are going to link with the set off and carry forward chapter. Now be very careful, dear students, because if you find any words such as derivatives, futures, options, currency futures, forward contract, hedging contract, etc. at recognized stock exchange, then don't confuse it to be speculative business. It is actually normal business. Okay. Now let's come to section 35 AD. Section 35 AD is a deduction which is allowed for some specified businesses. However, 35 AD benefit is not allowed for the assessees who are choosing the option of the new tax regime under section 115 BAC. So very important. Now what are the specified businesses? What are the specified businesses? There are 14 specified businesses. Number 1, cold chain facility for agricultural produce. Number 2, warehousing for agricultural produce. Number 3, warehousing for sugar. Number 4, laying of natural gas, crude or petroleum oil pipeline network. However, this business is there, no, natural gas, crude, petroleum oil pipeline network. This is allowed only if it is an Indian company and if the company makes the pipeline available for the others, okay, to use the pipeline. Next, number 5, slurry pipeline to transport the iron ore. Number 6, a hotel which is of 2-star or above category, means 2-star, 3-star, 4-star, 5-star hotel which is in India. Next, hospital with at least 100 beds in India. Number 8, housing project for slum redevelopment. Number 9, housing project for affordable housing. Number 10, inland container depot or container freight station. Number 11, semiconductor wafer fabrication manufacturing unit. Number 12, new infrastructure facility in public-private partnership mode. And number 13, production of fertilizer. And finally, number 14, beekeeping and production of honey and beeswax. So all these 14 businesses are called specified businesses. Sir, what is the benefit given to specified business? The benefit given to specified business is that it can claim 100% of the deduction, okay, of the capital expenditure also in the year of commencement. It can also claim 100% deduction on the prior period expenses. Okay, so very big deduction is given. However, section 35 AD benefit is optional. This is an amendment which is applicable for May 21 exam onwards. Section 35 AD benefit is now an optional benefit. Okay. Next, however, 35 AD benefit, that is 100% deduction on the capital expenditure and even prior period expenditure, it is not available if the expenditure is for goodwill, financial instrument or land. So no benefit for goodwill, no benefit for financial instrument, no benefit for land. Okay. Then again, no benefit of section 35 AD deduction is given if the payment, that is the expenditure, it is made to a person in a day exceeding rupees 10,000 in any mode other than account pay check, account pay bank draft, electronic clearing system or any other prescribed mode like credit card, debit card, net banking, IMPS, UPI, Bhim Aadhaar Pay, okay, NEFT, RTGS, etc. So the payment to procure the capital assets should only be via the prescribed modes. If it is not in the prescribed mode and the payment is more than 10,000 to a person in a day, then such amount is not eligible for the deduction. Okay. Then the business should be a new business. It should not be commencing by splitting up or reconstruction of an existing business. Then if 35 AD is allowed, then on the same amount, the deduction like 10AA and income based deduction under chapter 6A are not going to be allowed as deduction. Okay. Then in case of plant and machinery, only new plant and machinery is allowed for deduction. However, if old plant and machinery is within 20% of the total plant and machinery, then old plant and machinery will be considered as new plant and machinery. Hence, deduction is allowed for old also. And one more thing, if there is an imported plant and machinery, that is a plant and machinery which was used outside India and now it is brought into India, it is also considered as new plant and machinery if no depreciation has been claimed on such plant and machinery. Okay. So this was new plant and machinery. Next, if there is any loss, okay, after if If there is any loss from the specified business, then it can be set off only against the profit of specified business, and loss of specified business can be carried forward for infinite number of years. Okay, then if an assessee claims the benefit of section 35AD deduction for the purchase of certain asset, then that asset has to be used in the specified business for at least 8 years. Okay, if it is sold or destroyed within 8 years, then the amount received on sale or the amount received by the insurance company will be treated as income under PGBP. And one more thing, if before 8 years itself the assessee uses the 35AD specified asset in a business other than the specified business, then the PGBP income will be deduction claimed under section 35AD earlier minus depreciation that would have been allowed had the 35AD deduction not claimed, okay, will be the income under PGBP. I'll repeat once again, if the assessee uses the 35AD asset before 8 years itself in a non-specified business, then PGBP income will arise. What is the PGBP income? PGBP income is deduction which is already claimed under section 35AD minus the depreciation that would have been allowed on such asset. Okay, and this same amount that will become the PGBP will also become the cost of the asset for the business, that is non-specified business, for claiming depreciation. Okay, I hope you get my point. Similarly, this income is not applicable for sick industrial company. So if a company is a sick industrial company, then even though it transfers its asset from a specified business to a non-specified business, no need to tax any income. Okay, so I hope you are clear with section 35 AD. Very, very important, sir. Do solve the questions under section 35 AD to be thorough with the provision. Now let us see. Okay, let us first see section 10 AA. Section 10 AA, deduction for special economic zone. The section 10 AA deduction for special economic zone is also not available for section 115 BAC, that is the assessee who is choosing the new tax regime. Okay, firstly, who is eligible for SEZ deduction? Firstly, a person should be manufacturing or producing or providing services. Okay, and the assessee should be defined as an entrepreneur as per section 2J of the Special Economic Zone Act of 2005. Only then the assessee is eligible. Then there are certain conditions to claim the SEZ deduction. First condition in sir. First condition, the manufacture or production or service should begin between 1/4/2005 till 31/3/2020. Okay. However, there is an amendment which has been added which is telling that even though the service providing or production or manufacture did not begin within 31/3/2020, if the assessee has got the letter of approval required under the Special Economic Zone Act, then also the deduction is available to such assessee. Okay, next, the unit in the SEZ should be a new unit. It should not be by splitting up or reconstruction of an existing business. However, if an assessee is covered under section 33B, then this condition is not applicable. Okay, not so important, ignore it. Now, in here also, the condition is that only new plant and machinery should be used. However, old plant and machinery is allowed if the old plant and machinery is within 20% of the total plant and machinery. And if a plant and machinery is imported from outside India to India, even though it is a used one, it will be considered as new if no depreciation has been claimed on such plant and machinery. Okay, so the same point we learnt in 35 AD also, we are learning in 10 AA also. And here you have to get a report of a chartered accountant certifying the correctness of the deduction under section 10 AA. Only then, after all these conditions are satisfied, 10 AA deduction can be availed by the assessee. Now let us see how to calculate the deduction. Deduction under 10 AA is equal to export turnover of the SEZ unit divided by total turnover of the SEZ unit multiplied by profit of the SEZ unit. So export turnover divided by total turnover into profit of the SEZ unit. Okay, be very careful. So in the first 5 years of the business, 100% of the above amount, that is the formula amount, will be allowed as deduction. In the next 5 years, 50% will be allowed as deduction, and in the further 5 years, 50% will be allowed as deduction, subject to the condition that the amount should be transferred to SEZ reinvestment reserve account. So what will be the deduction in the year 11 to year 15? Amount transferred to SEZ reinvestment reserve, or 50%, whichever is lower. Now export turnover means what? The consideration for export brought into India. Total turnover means what? Total turnover of the SEZ unit. From all these turnover, you should reduce if there is any freight, telecom or insurance to deliver or render the service outside India, or if there is any expense in foreign exchange to render the service outside India. Okay. Export turnover, total turnover and profit should be taken only of the SEZ unit. So here you have to be very careful. Then if there is on-site development of computer software or service outside India, it will be considered as deemed export. Next, if there is any loss that is to be brought forward, then you have to reduce that loss from the eligible deduction, and only the remaining deduction can be claimed by the assessee. Fine. Now, condition for further 5 years. So if the assessee wants to claim the deduction under in year 11 to year 15, then amount has to be transferred to SEZ reinvestment reserve account. This SEZ reinvestment reserve account is nothing but a provision created in the balance sheet. So the money will be lying with the assessee only. It should not be deposited in any bank or anything. The money will be with the assessee only. However, it should be separately kept as SEZ reinvestment reserve account. And this SEZ reinvestment reserve account money should be used to buy a new plant and machinery, okay, within 3 years from the end of the previous year in which the reserve was created. Okay, then the particulars of the above should be submitted along with the return of income. Now I told you that the SEZ reinvestment reserve money should be kept by the assessee safely. Okay, the assessee should not use this money to give dividend. The assessee should not remit this money outside India, and the assessee should not remit the money outside India for creating an asset outside India. Okay, if the amount is misutilized, means if it is used for one of the three purposes, then such amount will be deemed as PGBP in the year of misutilization. And if within 3 years the assessee is not able to purchase any plant and machinery, then after 3 years that amount will become deemed PGBP, that is profit and gains of business or profession.
So there are changes in section 10AA, that is the section relating to SEZ. In your study material it is given in the deduction chapter, but I am taking it along with PGBP chapter itself. So now itself you make the changes. So in section 10AA, sir, what change is there? There are 3 minor changes, Kanna. What are the changes? Number 1, the section 10AA deduction can be claimed only if the income tax return is filed within the due date. Okay, so within the due date to file return of income, the assessee should file the return. If not, then 10AA deduction will not be allowed. Then next update, it is that we have seen this export turnover, correct? Export turnover. Sir, what is this export turnover? Export turnover will only be considered as the convertible foreign exchange brought into India within 6 months from the end of the previous year, or within further period as permitted by RBI. So what is considered as export turnover? Export turnover will only be the consideration which is in convertible foreign exchange. So it should be in foreign exchange, and that foreign exchange also should be brought within India within 6 months. Within 6 months from the end of the year, and if RBI gives further permission or further extension, then within that extended period it should be brought into India. Next, consideration is deemed to be received in India where export turnover is credited in a separate bank account maintained for that purpose outside India with the approval of RBI. So what they are telling now, Listen here. Let's say a person is doing export to USA, from India to USA. Let us take example of Mr. A. Correct. So in USA, let's say the turnover made from India to USA is 1 crore dollar. US dollar. Now what does the RBI tell? So what does the act tell? The act tells that this 1 crore US dollar should come within 6 months from end of year. It should come to India. But sometimes it is not feasible to bring that money back to India. Maybe it might be required to be there in the US also for further expenditure. So what this person Mr. A will do, Mr. A will take permission from RBI and he will tell that I will maintain separate bank account in USA. Okay, please grant me permission that whatever money I put it in the separate bank account in USA, it should be considered as money received in India. If RBI gives the permission, then such money also will be treated as it is received in India, or it is brought back to India.
Okay, other points not so important. So this was deduction under special economic zone. So now let us come to the next topic, that is agricultural income. So I told you that the constitution has not given the right to the parliament to tax agricultural income. The power is with state legislature. So Income Tax Act provides exemption on agricultural income via section 10 clause 1. 10 clause 1 provides exemption on agricultural income, but for that you should know what is agricultural income. Okay. First, agricultural income is defined under section 2 clause 1a. What is agricultural income? Number 1, rent or revenue received from a agricultural land. Okay, the land should be in India and it should be used for agriculture purpose. If the land is outside India, then that income is not eligible for the exemption under section 10 clause 1. Okay, so be very careful. So if a land is in USA and if I am getting agricultural income from USA agricultural land, the income is not exempt. It is very much taxable in India. Okay, now ownership is not necessary to get the rent. Okay, I told you example of subtenancy. So if I am getting the land on rent and I am giving the same land on rent to another person, then the rent that I am receiving, okay, it is also agricultural income if the land is a agricultural land. Next, number 2, any income received from the agricultural land by the activity of agriculture is called agriculture income. Example, plowing, sowing the seeds, etc. And also one special point, that income from nursery, it is also agricultural income. Then if there is any process which is done to make the produce fit for the market, it is also agricultural income. I told you example of the process of removing the chaff from the paddy crops to get the rice. So this process, the income earned by doing the process is agricultural income. And finally, sale of agriculture produce. If raw crops are sold, example tomato. So if tomato is sold, then the money received from the sale of tomato is agricultural income. However, if the crops are sold after processing, you have to see whether the process was compulsory for sale or process was not compulsory for sale. If the process was compulsory for sale, for example rice cannot be sold in a raw form as paddy. Rice has to be processed. Okay, the paddy crops are processed and rice is sold. Okay, so hence when rice is sold, the process is compulsory for sale, hence it is agricultural income. However, if process is not compulsory for sale, example tomato ketchup. Tomato can be sold directly also. However, if tomato is converted into ketchup and sold in the market, then it contains business income also, it contains agricultural income also. Sir, how are we going to differentiate both? Answer is using rule number 7. Rule number 7. In rule number 7, agricultural income, how to find agricultural income? Agricultural income is fair market value of the agricultural produce minus cost of agricultural produce. You will get the agriculture income. Then how to find the business income? Business income is equal to sale of the final product minus fair market value of agricultural produce that we had taken earlier minus any further cost that is done for agriculture. So I gave you example of tomato. If the example, the fair market value of tomato is 10 rupees, cost of tomato is 4 rupees, then agricultural income is 6 rupees. Then if selling price of tomato ketchup is 50, okay, in that you have to reduce the fair market value of tomato, that is 10, and further cost to make the tomato ketchup, that is 30 rupees. Hence 10 rupees will be business income. That is how we divided 16 rupees total income into business income of 10 and agricultural income of 6. Okay, I hope you are clear with the example. Now let's come to composite income, that is section 7a, section 7b and rule 7a, rule 7b and rule 8 of the income tax rules. Rule 7a talks about rubber, latex, crepice, senex, etc. In such case A is to B, that is agriculture is to business, will be 65 is to 35. 65% agriculture income, 35% business income. In case of rule 7b, which talks about coffee, there are two categories. If coffee is grown and cured, then the ratio is 75-25. 75 agriculture, 25 business. If the coffee is grown, cured, roasted and grounded, then agriculture 60, business 40. So the ratio is 60-40. Sir, what will happen if the coffee is only roasted and grounded? If it is only roasted and grounded, then it is purely business income. Okay. Then rule 8 talks about tea. For tea, the ratio is 60-40. 60% agriculture income, 40% business income. Then I told you one special point. In case of these composite incomes, that is 7A, 7B and 8, the full depreciation has to be reduced from the cost of the asset, okay, to find the WDV. Next. So first, what is the agricultural income? Rent from the agricultural land. Second, income from the agricultural land. Okay, and third point is income from farmhouse. Sir, what is a farmhouse? Farmhouse is a building which is on the agricultural land or in the immediate vicinity of the agricultural land. Means it is just touching the boundary. Okay. Income from farmhouse will be considered as agricultural income only if the farmhouse is used as a dwelling, that is a residence for farmers, or it is used for storage of the agricultural produce. Else it will not be allowed as agricultural income. So now in all these points related to agricultural income, we spoke about agricultural land. Let us discuss what is agricultural land. Very simple, sir. Any land on which the agriculture is done is called agricultural land. Okay. This agricultural land can be a rural agricultural land or urban agricultural land. Now, what is a rural agricultural land? Agricultural land in a rural area is called rural agricultural land. Okay. Then what is urban agricultural land? Any agricultural land which is in the urban area and it should be assessed to land revenue, and it should be assessed to land revenue only if both the conditions are satisfied, it will be called agricultural land. So rural area na enna, if a land is in rural area it will be considered rural agricultural land, but if the agricultural land is in urban area it will be called as an agricultural land only if it is assessed to the land revenue. Okay, chitta dangal patta etc etc. Now, what is urban area? What is urban area? Urban area is an area with the population of 10,000 people or more as per the last census. 10,000 people or more. Then, one more point. Okay, I gave you the example of Coimbatore. So, if the population of Coimbatore is 10,000 or more, Coimbatore will be called urban area. If the population of Coimbatore is more than 10,000 up to 1 lakh people, the 2 kilometer area outside Coimbatore will also be called as urban area. If the population of Coimbatore is more than 1 lakh up to 10 lakh people, then The 6 kilometer area outside Coimbatore will also be called urban area. If the population of Coimbatore is more than 10 lakhs, then the 8 kilometers area outside the boundary of Coimbatore will also be called urban area. Okay, so I hope you are clear by seeing this circle and diagram. Fine. Next, I gave you some examples of agriculture and non-agriculture income. Sir, rent received from land for grazing cattle is agriculture. Sale of seeds, agriculture. Sale from flowers, creepers like money plant, etc., agriculture. Sale of bamboo, agriculture. However, income from milk of cattle or milk products, not agriculture. Livestock, not agriculture. Poultry, dairy farming, fishery also not agriculture. Basically, any income which is got from animals and not crops, it will not be called agricultural income. Then, for selling the agricultural produce, if I give any commission, that is also not agriculture income. Then, if I sell forest products like timber, etc., that is also not agricultural income. And if an agricultural company pays dividend to its shareholder, then the dividend received will not be called agriculture income. Okay, so those are the examples. Then in agricultural income we studied the concept of partial integration. Partial integration, I told you in class that the government is not happy by giving so many benefits to the people. Okay, the government is telling you are getting the benefit of basic exemption limit also, you are getting the benefit of slab rate also, and you are getting the benefit of agriculture income exemption also. So they cannot tolerate this. Hence what they are doing, they are telling that whatever agriculture income is earned, that much they will block it in the slab. That much slab rate benefit will not be given to the assessee. Okay, I gave you detailed example in class. Let us see what are the conditions when this partial integration concept will apply. Partial integration concept will apply only if all the three conditions are satisfied. Condition number 1, the agricultural income should be greater than 5,000 rupees. Number 2, non-agricultural income should be greater than the basic exemption limit. And number 3, the assessee should be enjoying the benefit of basic exemption limit. So who are such assessees? Individual, HUF, AOP, BOI and AJP, that is artificial juridical person. So if all the three conditions are satisfied, you have to do partial integration. How to do partial integration? Step number 1, compute the tax of agriculture income plus non-agricultural income. Step number 2, compute the tax of agricultural income plus basic exemption limit. Okay. Step number 3, the total tax is equal to step 1 minus step 2. And then step number 4, you should add the surcharge, education cess or reduce the 87A rebate if any. Okay. So like this you should do partial integration. So with this, agricultural income comes to an end. Now let us discuss the final concept, that is the concept of alternate minimum tax, AMT. Alternate minimum tax. I told you, right, the government is not happy when the assessees claim so many benefits. So an assessee who is claiming either the benefit of section 35 AD or section 10 AA or income based deductions under 80 IA to 80 RRB, then for such assessees alternate minimum tax is applicable. Okay, let us see what is alternate minimum tax. Firstly, it is non-obstante clause means this section will override all the other provisions of the income tax law. Next, it is applicable to all the assessees except company. Sir, why not company? Because for the companies, MAT is applicable. MAT we will study in CA final. Okay. Now, for the assessees for whom the AMT is applicable, have to pay the AMT on adjusted total income, that is ATI, or the regular income tax, whichever is higher. So alternate minimum tax or regular income tax, whichever is higher, should be paid as AMT. Okay. What is the rate of AMT? It is 18.5% of the adjusted total income, and in case of IFSC, that is International Financial Service Center, it is 9% of adjusted total income. After finding this 18.5% or 9%, Above that you should add 4% education cess surcharge, etc. Okay. Now how to calculate adjusted total income? Adjusted total income is basically the total income on which you should reverse all the deductions under section 35AD, 10AA and income based deductions. You have to reverse them. So how to reverse them, sir? First take the total income, okay, then add back the deductions which have been claimed under section 10AA, then income based deduction under chapter 6A, that is 80IA to 80RRB, and then deduction under section 35AD. So add them back. However, if 35AD deduction will not be claimed, then the assessee can claim depreciation, correct? So the depreciation which would have been claimed should be reduced from this answer. So the final amount that is received will be adjusted total income. So what you should do? Total income, add back the deduction claimed under section 10AA, okay, chapter 6A deductions, that is income based deductions, and then 35AD deduction, and then reduce the depreciation on the 35AD assets that would have been available. Okay, you will get the adjusted total income. On this ATI you should calculate 18.5 percentage. Now I will talk about AMT credit. Sir, I told you that actual income tax or alternate minimum tax, whichever is higher, should be paid by the assessee. So the assessee goes to the government and is telling the government that this is pure injustice. You are doing wrong. First, because of the deduction, my tax has become so low, and now you are not giving me the benefit of the lower tax. You are asking me to pay the alternate minimum tax. So the government is telling, chill bro, I will give you this alternate minimum tax as credit. Hence, whenever alternate minimum tax is greater than the regular income tax, then the difference will be available as AMT credit. This AMT credit can be carried forward for a period of 15 years. And when can you set off this AMT credit? It can be set off when regular income tax is greater than AMT, but it is restricted to the excess of regular income tax over AMT. So I gave you an example where the AMT is, let's say the AMT is how much? 18 lakhs, okay, and the regular income tax is how much? Only 4 lakhs. Then how much will be the AMT credit? The AMT credit will be 14 lakhs. Correct? That is the excess of AMT over regular income tax. How much should be actually paid to the government in the year? AMT should be paid to the government during the year. This 14 lakhs can be carried forward for 15 years. Correct? Finally, let's say after 3 or 4 years, let's say the actual income tax is 10 lakhs and the AMT is only 7 lakhs. Actual income tax 10 lakhs, AMT is only 7 lakhs. Then how much is the difference? Difference is 3 lakhs. So they are telling this 3 lakhs difference can be set off using this 14 lakhs credit. So this 14 lakhs will become 11 lakhs and this 3 lakhs can be set off. The balance, that is 7 lakhs, need to be paid to the government. And if there is a year in which AMT is not applicable, so let's say income tax is 10 lakhs and AMT itself is not applicable, hence it's 0, then this credit of 11 lakhs can be used to set off this entire income tax of 10 lakhs and nothing needs to be paid by the assessee. Okay. So read the provisions carefully. Sir, will the government give any interest over AMT? Answer is not at all. No interest on AMT credit. Okay. Any other provision like advance tax, interest under section 234 A, B, C, etc. should be calculated on AMT. If AMT is applicable, then advance tax and interest should be calculated on the AMT credit, not on the actual income tax. So be very, very careful. And in your examination, it is not necessary that the examiner will tell you directly to calculate the AMT. You should see whether AMT is applicable or not in the question and you have to find the answer. Okay, so question can be hidden one also. Next, who is exempt from AMT? Who need not pay alternate minimum tax? Firstly, we discussed companies are exempt from AMT because for them MAT is applicable. Next, any assessee who does not claim any deduction under 10AA, 35AD or income based deduction, for them also AMT is not applicable. Okay, then any individual, HUF, AOP, BOI or artificial juridical person whose adjusted total income is up to 20 lakhs, for them also AMT is not applicable. So if adjusted total income is above 20 lakhs, AMT applicable, up to 20 lakhs, AMT not applicable. Then even if AMT is not applicable, AMT credit is available, it can be set off against the regular income tax, which I already told you. Then, if AMT is applicable, assessee should get a report from a chartered accountant certifying the computation of AMT and adjusted total income. What is the due date of this report? It is 1 month before the due date to furnish return of income as per section 44AB. Okay, tax audit. So, these were the provision of AMT credit. Okay, so in detail I have given you the revision lecture for PGBP chapter. I hope you are thorough with it. Solve as many questions as possible so that you do not make any silly mistakes. Keep preparing. Okay, take care. See you in the next video. Till then, bye bye.